Good morning, ladies and gentlemen, and welcome to the second day of the G20 Cross-Border Payments Conference. I'm your host, Mavis Mahlwana. The first day of the event led us to have very impactful dialogues where I made a few observations. The first one being that cross-border payment, there was acknowledgement that cross-border payments matter, especially such as those of remittances. We serve as a livelihood for many. Secondly, that the data that is on hand informs us that the challenges facing cross-border payments, such as speed, costs, access, and transparency, remain and are more nuanced in the Sub-Saharan African region. By the end of the day, I'd equally made other observations. One of these being that a common thread of words started to emerge amongst the speakers who were calling for less talk and more action through enhanced collaboration and cooperation, not just amongst the public and private sector, but amongst the regulators themselves. There was also a call for us to be a bit more consumer-focused in the tailoring of regulations, policies, and payment solutions. I'm optimistic that the second day and final day of the event will equally be action and solution-orientated. To set the tone for the final day of the event, please help me welcome the Governor of the South African Reserve Bank, Lesetja Kganyago, to the stage.
Thank you very much, Mavis. And what are you looking for? Are you suggesting that Mavis is shorter than me, so you have to adjust the microphone higher? I thought that the G20 finance track was closed in Washington last week, but clearly payments don't sleep. And so the payments track is continuing, and there is a reason for that. And it is because the work of the G20 finance track with respect to payments emanates from the summit of the leaders. And it is the only track in the finance track that reports to the summit. And so we have got to present a report to the summit. So I understand why you continued to work in this manner. So it gives me a great pleasure to welcome you to this second day of this important conference. Particularly pleased to welcome senior representatives from G20 member countries, but importantly, representatives of the African central banks and finance ministries and the private sector. Your participation underscores the importance of this area of work and the shared commitment to achieving the G20 roadmap targets of faster, more affordable, more transparent, and more inclusive cross-border payments by 2027. Cross-border payments, of course, are the lifeblood of international trade. International trade is the lifeblood of the global economy. So payments play a very important role. And the global economy depends on the flow of investment, the flow of capital, the flow of remittances, and of course, economic integrations. These things are not possible unless you have got functioning, efficient, and cost-effective payment systems. Despite their critical role, cross-border transactions remain far too costly, too slow, and opaque, especially in emerging markets and developing economies. As part of South Africa's G20 presidency, we have placed cross-border payments high on the finance track agenda. Our goal is to enrich the global conversation with regional insights and to foster collaboration that translates ambition into action and tangible outcomes. We have worked closely with the Financial Stability Board and the Committee on Payments and Market Infrastructures under the leadership of Governor Panetta. We have also worked with G20 members to advance the FSB's G20 roadmap for addressing the cross-border payments challenges. Since the launch of the roadmap in 2020, we have seen meaningful progress. However, the journey is far from complete. In Sub-Saharan Africa, fragmented infrastructure, limited interoperability, and data gaps continue to hinder the efficiency and inclusivity of cross-border payments. At the same time, the region is seeing innovations in fast payments and fintech that may well prove transformative. The world is moving, excuse the cliche, the world is moving fast in the area of fast payments. And Africa might be left behind unless we catch up with that. Moves are afoot to link the fast payment systems of the various countries on the continent and across the continent. And this is going to prove to be transformative. But the biggest constraints in these interlinkages are behind the border. And so it is important that we lift the game and make sure that our own local payment systems are fit for purpose and could actually make that interlinkage more accessible. This conference is a timely opportunity to reflect on these developments, guided by our key themes, which are understanding the user needs, regional dynamics, unlocking policy and infrastructure barriers, fostering trust and innovation, and measuring what matters. This blend of academic rigor and policy relevance will help us identify actionable pathways to improve cross-border payment ecosystems across our region. As policymakers, we have no choice but to understand the challenges and, importantly, after we have understood the challenges, to act decisively in addressing those challenges. At a high level, this requires strengthening regional cooperation, modernizing and aligning regulatory frameworks, and investing in interoperable infrastructure. We also need reliable and accessible data to guide our decisions and measure our progress. And we must ensure that our efforts are inclusive, serving the needs of all users, especially those who rely on remittances and small value transfers as economic lifelines. Together, we can ensure that cross-border payments serve as a catalyst for inclusive growth and regional integration in Sub-Saharan Africa and beyond. I take this opportunity once again to wish you productive and an engaging second day. And I hope that not only will you be stuck in the deliberations about payments, and that you will take your gadgets and visit South African malls and places of interest and see whether your gadgets are interoperable with the systems that we have in our country. Thank you very much for your attention, and may you have fruitful deliberations.
Thank you so much, Governor, for those opening remarks. And indeed, I think I forgot to make a request yesterday to our international guests to please make time to provide us with some much needed foreign direct investment by visiting malls and so on. So thank you for reminding the colleagues to do exactly that. Colleagues, we are now going to just shift gear to commence with our program for the day. And as we did yesterday, we have research sessions and we have also policy panel sessions. Before we move into the policy panel and research sessions that we had yesterday, We'll first kick off today's session with setting the stage under the topic Shaping Payments and Digital Finance. Here we have two presenters. They are unable to join us in person, so they will be presenting virtually to us. But essentially, the first presenter will cover the evolution of retail payments, more especially the rise of instant payments. And then the second speaker will speak to the impact of digital finance on savings and investment decisions in South Africa. Please help me to welcome online Maha LD Mahi, who is the head of the BIS Innovation Hub in Singapore. Maha, I hope you are ready for us online. I do see you, Maha, just checking if I'm audible to you. I think you may be muted as I'm unable to hear you.
I can hear you, Maha, but I think they can't.
Okay, I don't know what the issue is because
I can hear you now. I seem to have lost you once again. Can we do a test audio, Maha?
Yes, I'm here. Can you hear me now?
Yes, perfectly. Over to you.
Okay, thank you very much. I hope someone is putting up the slides. Is that possible?
Technical team, are you able to put up the slides?
Thank you. Excellent. Well, thank you. First of all, my sincere thanks to the G20 presidency, the South African Reserve Bank and the Bank for International Settlements Committee on Payments and Market Infrastructure for the kind invitation to present. I'd like to also acknowledge my co-authors of the paper that we submitted, who worked with us on this paper. Obviously, it was developed by the Bank for International Settlements Innovation Hub, and I'll acknowledge my colleague Carmen Arias, the South African Reserve Bank, with special thanks to you, Mavis, and Chris Hamilton, as well as the Reserve Bank of India, led by Harinder Singh, and the National Payments Corporation of India. The team was led by Ritesh Shukla, the CEO. So we examined the global shift from cash to digital payments, focusing on how instant payment systems have become a key priority for modern financial ecosystems. And we draw on the experiences of India and Sub-Saharan Africa with a special focus on South Africa. So the paper explores how diverse local conditions, public-private collaboration, and digital infrastructure have shaped innovation, financial inclusion, and economic growth in various markets. And the analysis underscores that success depends not only on technology, but also interoperability, trust, alignment with local customs and behaviors. We hope to kind of draw out some valuable lessons from the work. On the next slide, please. The presentation outline, or the paper, the way we looked at the paper, it focuses on three key areas: the evolution of payment systems from cash to a myriad of electronic offerings, which sort of describes the evolution of payments in emerging markets, and that profound transformation from sort of traditional money as your social convention to a dynamic, technology-driven ecosystem with innovation at its heart. We also look at domestic instant payment systems and focusing on India and Sub-Saharan Africa, again, like I said, with a focus on South Africa. And we look at the future. From here, where do we go? And what could technology bring? And how can we achieve the G20 target roadmap? And we sort of talk a little bit about the work that we're doing in the Innovation Hub. Now, on the next slide, please. The transformation of payments over recent decades has been nothing short of remarkable. I think we all agree it's a fascinating journey. It started with cash as the primary medium of exchange. It actually remains the most trusted and inclusive form of money. Whilst there's been that evolution towards payments, some of the characteristics of cash have been cited as important, resilience, scalability, and trust. And of course, digital payments started to emerge, and they were created to sort of allow trading without having to carry physical large amounts of cash around. And different instruments were adopted over the past, decades and scaled in different ways. So, for example, in the United States, some countries in Europe, especially during the mid-1900s, checks were widely adopted. And then in the late 1950s and 1960s, we started to see credit card and debit cards started to be adopted. And in 2001, South Korea introduced the electronic banking system, EBS, and that was considered one of the first, let's say, fast payment systems that were developed. Now, on the category of e-money, e-wallets, and mobile wallets, the P2P payment apps, it really shows the power of super apps, which allows consumers to seamlessly pay for everything from street food, to online shopping directly through their smartphones. And this was sort of really catalyzed through the proliferation of smartphones. And notable examples are Alipay, WeChat in China, Grab in Southeast Asia. But one of the most significant advances we've noted is in the payments landscape has been the rise of real-time payments or instant payment systems. And that's really enabling instant 24/7 funds transfer between bank accounts. And it's not just sort of a person-to-person payment, it's starting to extend its use cases, including merchant payments via QR codes, small and medium enterprise transactions, and B2B payments. On the next slide, please. So FPS has been a focus of us in this paper because it is becoming a key pillar of well-functioning financial systems. And so you can see here globally, over 75 countries have implemented fast payment systems or instant payment systems, and more are following suit. And it's been a real pillar in driving digital payments and digital payments adoption. So, it's shown that it's bringing benefits to individuals, businesses, governments alike, and the numbers really speak for themselves. So according to ACI Worldwide, the overall of fast payment transaction volumes grew 63% to reach a new high of 195 billion transactions, and that's back in 2022, and it was estimated by 2027 the figure was forecast to hit 512 billion transactions, which is a compound annual growth rate of about 21%. On the next slide, please. So, cross-border payments are, domestically, we've cited sort of the proliferation of instant payment systems. And when we look at cross-border payments, they're a bit more complex than domestic payments due to the potential involvement of multiple intermediaries, the divergent legal and regulatory framework and various, consumer behaviors in various countries. But notwithstanding this, instant payment system linkages is relatively untapped, as a solution to enhance cross-border payments. And we think, or we've seen that it could shorten the transaction chains, enabling, participating institutions to perhaps cut down some of the intermediaries and recreate some efficiency in cross-border payments. And so it's really kind of one of those initiatives that were identified by the G20 as one of priority action to help achieve the target roadmap in terms of cost, speed, access, and transparency targets. And the good news is that it's starting to happen, and we've seen bilateral instant payment linkages, particularly in Asia, where we've seen Singapore, Malaysia, Singapore, Thailand, India has linked with a number of countries. And according to Financial Stability Board, over 40% of instant payment system operators that were surveyed plan to establish some form of instant payment system link within the next 2 years. However, connecting countries one-to-one is a complex exercise. So every instant payment system operator, or every bilateral link needs sort of complex technical integration, multi-party legal negotiations, and so on. And so how can we really scale these interlinkages without it being bilateral every time? And this is where an idea that was initiated out of the BIS Innovation Hub, Project Nexus, started to look at a multilateral link where instant payment systems can connect once. and by doing that, they connect to all of the other IPSs that are linked to that hub. And now, actually, Nexus is an implementation phase, and we're in handover, where an independent entity owned by 5 central banks has been established to bring Nexus to live implementation. So let's move to the next slide, and this is where we start to talk about some of the local experiences, and we start with India. Now, India has historically been a cash-dominated economy, with roughly 78% of all transactions still cash-based as of 2016, apologies, as of 2016. Now, key enablers of India's, digital adoption were what is called the Jan Jan Yojana initiative. This is mass bank account opening, as well as Aadhaar for biometric digital identity, and the expansion of mobile telecommunication. So together, these pillars of digital public infrastructure brought hundreds of millions of previously unbanked citizens into the formal financial system. But it was all done through mobile wallets, and they had their limitation, particularly that they weren't interoperable. So the government of India and Reserve Bank of India capitalized on these technologies by promoting the UPI, which is to unify digital payments landscape through a single mobile-first interface. And UPI transactions jumped from 100,000 in October 2016 to over 2 million within 2 months by December 2016. And it crossed 16 million monthly transactions by August 2017, so only a year later. And as of mid-2025, UPI volumes have continued to increase, and they're at an impressive 19 billion transactions monthly, which serves, and here are some statistics for you, it serves 490 million users, with over 65 million merchants, 678 million merchant QRs, and that accounts for about 85% of all digital volumes. So it's estimated that 85.5% of Indian households have at least one smartphone, and that sort of helped that adoption. On the next slide, please. So the transformation hasn't been without challenges. Sustaining UPI's success needs continuous effort to tackle issues such as cybersecurity risks, rural connectivity gaps, as well as various levels of digital literacy. And this is where authorities are also actively, addressing these through enhancing safeguards, offline payment solutions, and national financial education campaigns. So what's next for India? Well, UPI continues to grow domestically, expanding into new domains such as credit, e-commerce, and agriculture, as well as looking at interoperability efforts on a global basis. And as I said, Project Nexus, they've done bilaterals, and they are a founding member of Project Nexus, the multilateral system. So let's now move to Sub-Saharan Africa, please. Next slide. So from an economic perspective, Sub-Saharan Africa contains 3 major challenges. Some of the world's poorest communities, it has a myriad, a mosaic of national regulations, and a highly diversified currency environment. And an African Ender report identifies 28 domestic IPSs in 20 African countries, which connect banks and multinational organizations in various ways. And of these, actually 14 enable interoperability between bank accounts and mobile money wallets. And so the rise of digital economy in the region has created these opportunities to innovate. And perhaps one of the most famous innovations is M-Pesa in Kenya, which is an electronic money transfer product, and it really sort of revolutionized financial inclusion in Kenya. And so this is through sort of through the mobile service, where it increased the use of financial services from 26.7% to 75% of Kenyan adults over a decade from 2016. And this was expanded to 9 different countries. And so it's been sort of an example of real, results in financial inclusion. And it's been one of those case studies looked at everywhere. So in Sub-Saharan Africa, account ownership also increased, and that's grown from 34% to 58% of adults, and this is in the 10 years up until 2024. So, but there's still challenges. I mean, challenges in the region are common to other regions. It still faces fragmentation, limited interoperability, and this cash reliance. But also Sub-Saharan Africa is expanding on a cross-border basis, its cross-border initiatives. And it's really looking at sort of moving towards interoperable, inclusive digital infrastructure. And already has, the region already has 2 regional and 1 continental instant payment system live, and 4 more regional systems in development. On the next slide, please, we'll focus on South Africa. So with South Africa, as of 2016, the economy rate remains stuck between developed and developing economies. And that's sort of been a bit of a trend, I suppose, that South Africa has experienced, with a predominantly cash-based economy, right? So with that, the industry and regulator have responded kind of with a multi-implementation of new domestic fast payment systems, PayShap, and this is specifically designed to really address that cash challenge. And after 2 years in operation for PayShap, it now has 12 banks participating, and over 40 million transactions have been processed. So the numbers are growing month on month. There's sort of double-digit growth on PayShap transactions. And as a next step in South Africa, the South African Reserve Bank established the Payments Ecosystem Modernization Program, with focus on payment infrastructure as a public good, and sort of really aiming for a fundamental shift in payments landscape with various elements in the space of digital identity and e-signatures, digital payments and data sharing. And so with this and other initiatives, the South African Reserve Bank aims to transform South Africa from predominantly cash-based economy to one with sort of broader access to digital payments, and really kind of, the aim to foster sort of a more digital economy, contribute to economic growth. So now I'll move on to sort of the future. So if we could move to the next slide, please. Having seen how digital payments have evolved in India across Sub-Saharan Africa, we kind of look to the future. What's next? And the FSB G20 roadmap for enhancing cross-border payments developed obviously with the G20 and the CPMI, it lays out a clear targets, right, and priority actions. And what we've done in the BIS Innovation Hub, I've given you sort of a snippet of some of the work that we've done in the Innovation Hub to really support that, those targets and support those efforts. And for the purposes of the paper, we focused on interoperability of payment infrastructure to ensure seamless cross-border connectivity, removing friction, particularly in terms of compliance and fighting financial crime. It's always seen as a friction point, and how can we streamline and automate that? And improving foreign exchange clearing and settlements, how can we create efficiencies through that process as well? So on the next slide, please. So here we demonstrate how some of next slide. Thank you. Here we demonstrate how some of these projects have come together to really imagine what the future would look like. So that top layer, right at the top, is instant payment system interlinking, which I've described, whether bilaterally or multilaterally. And these are using existing structures that we operate today that actually process quite a large number of transactions. Then we looked at the middle layer. There is what I described in terms of foreign exchange clearing and settlements. And one of our projects, Project Rialto, was experimenting with how can this be made more efficient with tokenizing FX and using tokenized central bank money sort of as a settlement asset. And obviously that's experimental, but it sort of gives the idea of how technology might play a part in removing frictions and making the process more efficient. And of course, the final layer there is looking at that friction around compliance and compliance processes and regulatory requirements. And here we look at how can we use technology to automate and streamline compliance by, let's say, front-loading or pre-validating all the compliance checks and creating a verifiable proof that can travel with the transaction. And we've demonstrated that can actually create efficiencies for, the compliance process. On the next slide, please. Thank you. As we look at the future and as we look at sort of changes in what technology brings, it's important that we constantly look at the integrity of the financial system. And we've demonstrated how, again, some of our work has really focused on, ensuring integrity of the financial system by using new technologies. And so we have this, and as we put together some of our work, they naturally fit together in what we're calling a technology stack for compliance and fighting financial crime. So the first component of that technology stack is what I mentioned through Project Mandela, the streamlining compliance processes, through what we call, programmable compliance and transaction pre-validation. So it pre-validates all the requirements of compliance, all the compliance requirements, respecting jurisdictional differences for a particular profile transaction. We pre-validate, we create a verifiable proof, and that travels with the transaction, and that can work. It's a modular system, so it could work with existing as well as existing infrastructure, as well as new digital asset infrastructure. Now, the second component is Project Hertha, which demonstrates that advanced artificial intelligence and network analytics, if you apply it to a national retail payment system, it can support detection of financial crime patterns and merit that review. And this is in sort of a real time or near real time. And Project Aurora also demonstrated how the application of AI and machine learning techniques can identify money laundering and financial crime networks, both nationally and internationally. And again, doing that sort of proactively can really help with the quest to, continue to support the integrity of the financial system. And then two other projects we had were around the cybersecurity project Raven and Project Polaris. And again, these were important in terms of our work on the technology stack. Now, if we move to the next slide, please. Now, here we talk about the concept of tokenization and how that holds promise for the future of cross-border payments and the future, in fact, of the financial markets, where, with tokenization, we can enable, fundamental transformation in financial market infrastructure and reimagine how we, transact today and what that could look like in the future. And as we know, tokenization is a digital representation of value, how we record it, record the ownership, we transfer it on, shared ledgers. And it's got multiple, characteristics that are very helpful for payments, in particular for cross-border payments, namely its programmability feature, which, we can achieve things like atomic settlement, where a whole transaction chain is inseparable. We can also achieve things like composability, and this is where we can construct, transactions in ways that we haven't done before. And so these features we think are very helpful in terms of improving, enhancing how we do payments today. And of course, when we look at tokenization throughout our work, we look at how can we enhance existing structures, deeply entrenched structures, and how could we enable the new. My final slide, I can hear that the bell has gone off. So this is, in conclusion, different economies have followed their own model. And they look at sort of their tailored needs and impacts, infrastructure, policy, environments, and there's no single model for success. But the common thread is a user-centric design, coordinated governance, public-private partnerships that achieve our collective process. So that continued engagement, the cooperation, and the platforms like this are very helpful to advance, cross-border payments. I will stop there. Thank you very much. I appreciate all of your attention. Apologies for going over time.
Thank you so much, Maha, for sharing with us the global experiences as well as India's, South Africa, and Sub-Saharan experience when it comes to evolving from usage of cash to then retail payments, to then as in what we're seeing with instant payments, and then also what we are likely to see further evolving here on. I am hoping that perhaps probably once Judith takes us through her presentation, if the time allows, we can take a question or two for Maha. So hopefully, Maha, you can still stay with us for this segment. And if we have time, we'll allow the audiences and to table a question or two. Without further ado, I know we have Judith on the line, and Judith will be presenting on the impact of digital finance channels on saving and investment decisions in South Africa. Judith, over to you.
Hello, everyone. Can you guys hear me?
Yes, we can hear you perfectly.
Okay, and you can see the slides, correct?
Yes, we can.
Okay, great. Well, thank you so much for the opportunity to present our work. I wish I could be there in person, but unfortunately, COVID got the better of me. Now, this is joint work together with Arif from the SARB and John Frost and Vatsala Shredi from the BIS. And we study the impact of digital finance channels on saving and investment decisions in South Africa. Now, you might wonder why a paper on domestic saving and investment decisions is part of the program of a cross-border payment conference. And this links a little bit to one of the topics that emerged in a lot of talks that we had yesterday, is that there are important spillover effects from the domestic developments in the financial services industry and digital payments that then create spillover effects in cross-border payments. Now, saving and investment participation is crucial to the domestic economy, not just because it affects the financial well-being of individuals, but actually the participation in saving and investments of individuals also has important implications for the overall economy in terms of financial stability, the ability of the economy to absorb shocks, market depth, the fiscal burden, and the reliance of foreign investments. Now, if saving and investment participation is so important, not just to individuals, but also to the economy, why do then people not save and invest? And where can digital finance channels help? Now, there are obviously a lot of reasons why people don't save and invest, and digital finance channels cannot address all of them, but we think they have a large potential in especially contributing to two channels. One is cost. So technology can make financial services more cost efficient, both for the provider and for the consumer. And technology also has the potential to simplify the saving and investment process. So many people don't know where to start investing or saving. They don't understand the products, etc. Now, technology can facilitate implementing behavioral nudges and simplifying the process, for example, through automated saving tools, robo-advising, or even just having the feature of seeing your real-time balance on your mobile screen has shown to improve trust in financial services. Now, there is already some evidence of the potential benefits of these digital finance channels. The issue with the current evidence is that it's mostly based on registry data. So we have great evidence on, for example, how people behave within these saving and investment apps. However, to be within the sample of these analyses, you already have to be a user of these apps. Now, we will see in a couple of slides that this is not really representative of the whole population. There's a specific group of people that adopt to these things. So we try to contribute with our paper by providing a more holistic picture and using data representative of the South African population to kind of get a better idea of who adopts to these tools and who benefits and who doesn't. Now, I don't have to tell this audience why South Africa is a highly relevant jurisdiction to study digital finance channels, but I will tell you why South Africa is a highly interesting jurisdiction to study digital finance channels. Because on one side, South Africa has a quite developed financial sector. It has well-established capital markets. Most South Africans have access to some sort of form of financial product, and most South Africans also have a smart or mobile phone. Now, while it looks like South Africa has some of the important tools already in place to make digital finance channels successful, South Africa also faces important structural challenges such as high unemployment, high wealth inequality, low saving rates, and a highly concentrated banking sector. So it's not directly clear whether digital finance channels are enough to overcome these large challenges. Now, the data that we use for our study is the Finmark Trust data. It's an independent nonprofit organization focused on financial inclusion, not just in South Africa, but generally in Africa. Now we use the annual waves from 2019 and 2021 to 2023, with potentially being able to extend it to also a larger time frame. The survey interviews around 5,000 individuals annually, and in addition to some variables on digital finance channels and saving outcomes, it also has extensive demographic and socioeconomic information, which really helps us to study also which part of the population adopts to these methods. Now, for our digital finance variables, we focus on two groups of digital finance adoption. One is digital finance behavior. So regardless of whether you have a traditional bank account or a fintech bank account, we look at whether you do things such as online banking or whether you receive or send money digitally. And then we also look at the banking choice. So whether you have a bank account at a fintech-only bank, such as, for example, Time Bank. For the saving outcomes, we look at different variables. So whether you save or not, how much of your monthly budget you allocate to savings, whether you diversify, so whether you have multiple different saving methods, whether you allocate them to formal methods, whether you have long-term oriented saving goals or not, etc. Now, when we just have a quick look at the descriptors, we can see that it's actually not a large portion of the sample that adopts to these digital channels. On the digital behavior side, we can see that it's roughly 15% of the sample that do mobile banking or send money or receive money digitally, while for the fintech bank adoption, it's even less. It's roughly 1% of the sample that exclusively has a fintech-only bank account, and another 1% that has both a traditional bank account and a fintech-only bank account. Now, when we look at who adopts to these digital channels, we start to see a clear divide between adopters of the digital behavior and adopters of the digital-only banks or the fintech-only banks. So here we can see in green that the people that adopt to digital behaviors have higher than average incomes, whether the people in light blue that adopt to only fintech banks have below average incomes. When we look at the demographics, also interesting trends emerge, because on one side we see some similarities in the adopters and also some big differences. So here in red, we can see that the people that adopt to digital behaviors have higher incomes, they're more educated, and they're also more likely to be white. While the people in green that adopt to fintech banks, they have lower incomes. They're kind of around average in terms of education, and they're less likely to be white. So these are some big differences, but there's also some similarities. On average, both younger people, males, and people in more urban settings are both more likely to adopt to digital behaviors and to digital-only banks. So it looks like on the digital behavior side, it's mostly well-educated, high-income, white males that just stick to their traditional bank accounts and then adopt to these digital behaviors, while the digital-only banks are able to capture some of the underserved segment of the population. Now, going on to our regressions, we can see that while the digital-only banks seem to be able to capture some of these underserved segment of the population, it doesn't seem to translate into better saving and investment behavior yet. So here we can see that, yes, the people with digital behavior, they're more likely to save. We don't see this effect for the digital-only bank adopters. The trends continue when we look at the proportion in formal investment methods, the number of saving methods, and whether you have a rainy day fund or not, and also the amount that you allocate to savings each month. It's mostly the people with digital behaviors that seem to show better saving and investment patterns, while the people with digital-only bank accounts don't seem to have any improved saving behaviors. Now, we're still at the early stages of this process, of this project, and the evidence that we have for now are only correlations. What we cannot distinguish for now with our analysis is whether the observed effects are actually due to the digital channels or whether it's people with better financial habits that are just more likely to adopt. So basically, it's still an open question whether digital finance channels actually improve saving and investment behavior or whether it's just amplifying pre-existing tendencies. Now, we try to address this in the future with capturing some sort of shock to adoption so that we can disentangle the effect of digital channels. Now, in addition to our quantitative analysis, we have also talked a lot to regulators and industry practitioners. And while we're looking for extra data sources to prove these claims with data, there's some topics that I wanted to highlight that keep emerging in these discussions. One are the structural barriers that keep people from saving. So there's a large portion in South Africa that just have low incomes and just don't have the capacity to save. Now, you mix that with high banking costs and high minimum deposits, and people just cannot afford to form part of formal financial services. Second is the cash-based economy. So there's some essential services that are still only cash-based, such as buses and certain transportation methods, or some merchants that will only accept cash. Now, people need cash for their day-to-day activities, and then moving cash to digital money by depositing it in ATMs, etc., is still costly. Therefore, this moving in and out of cash is very inconvenient, so people just opt for pulling out their entire salary into cash and keeping it into cash. Third is the strong informal economy that exists in South Africa. Now, informal saving methods such as stockwells are deeply ingrained into the South African culture, and those are methods that people trust, that they understand, and that they feel in control with. Now, those people also don't trust banks, and they don't understand the fees, so they're very reluctant to switch from these methods that they deeply trust and feel identified with to these formal methods. And fourth is still the persisting issues with the infrastructure. So mobile data and fiber internet is still very expensive and unreliable, especially in rural areas. Therefore, if, for example, you're trying to use digital payment methods, but it costs you a lot of money because of the data, or then you don't have any connection, you see that it doesn't work and you go back to cash. So these are also some points that we still want to investigate further with our study. So let me wrap up here. What we see for now in our data is that the adoption by underserved groups is rising, but it doesn't appear to have led to substantial changes in saving and investment behavior yet. The benefits that we see are largest for the already well-served individuals, and further identification is needed to see if adoption actually improves saving and investment behavior, or whether it just reflects existing financial habits. And then these future insights will hopefully tell us whether technology improves decisions or just amplifies pre-existing tendencies. Thank you.
Thank you so much, Judith, as well as the team who jointly authored the paper, one of them being Arif himself. So I think those were very valuable insights, and I do see that we still have time that Judith graciously has left us, which enables us to take questions for both her and Maha as well. So, colleagues, any questions with the insights that have been shared? Okay. There is a question, thanks. If you can just introduce yourself or the organization. And
hello, everyone. It's Mpumi from Pay Inc. My question is for Maha with regards to the instant payment the instant payment solutions that she was talking about with regards to the linkages that happen in those environments. My question is, have you seen an environment where the linkages have happened at a multilateral level, and not necessarily bilateral, but multilateral level, and what were the challenges that the various role players actually experienced there?
All right, thank you. Maybe let me just take another question and then we'll bring it to the colleagues.
Yeah, thank you. Thank you, Mukitimi Mudawuzi, South African Reserve Bank. I wanted to ask, my question is more related to the second paper. I think if you, and the introduction of behavioral finance and economics in how it was interpreted, I think the introduction of nudges for me was an important aspect to look at, because I think we can all accept from a financial sector perspective, trust is a very important component to a consumer's choice. And most of the nudges that exist in traditional banking apps and traditional banking channels are usually nudges towards me spending, right? Where perhaps it would be a nudge to open a credit card or a nudge to spend more and get loyalty points. But I think it's interesting to see a paper looking at nudges from a savings perspective. And I think I wanted the speaker to perhaps expand a bit more on that, to say, how would they then see those nudges playing out if we were to use payment channels to have people being nudged to saving more? Because I think the perspective is always that I must spend my money and not save it when I look at the financial infrastructure. Thank you.
All right, thank you. So Maha and Judith, those are the two questions. Maha, we'll start with you, and then Judith, the second question was for you.
Thank you very much. Thank you for the question. There isn't a multilateral interlinkage that is live today. Nexus is one of the first. I mean, there's various versions of multilateral structures, but in terms of a hub and instant payment systems linking, there isn't. I can share very quickly some of the challenges that we tried to anticipate and overcome, taking inspiration from the bilateral linkages. And these are the legal and governance frameworks are different in different jurisdictions. So having multiple parties agree on what that scheme rule book needs to look like, what is the governance framework, is important to get right straight away. The second is ensuring that we're building in safety and security and resilience in the structure, because obviously the moment something new is established, attackers could potentially target it, and there'll be fraud and economic crime and so on. And the third is, if we're looking at something that is scalable for multiple jurisdictions to join, not just in Asia but across the globe, all of the different components of establishing the blueprint for a production grade structure like this have to take scalability into account, including the technology, the scheme and governance rulebook, as well as the financial, sustainability model, the incentives. And by the way, incentives were a very important component to this. So I could share some of the things that we had, but there isn't a structure that is identical to Nexus that actually exists and is live today.
Thanks so much, Maha. Judith, I know that we are sort of out of time, but if in 30 seconds you can respond to the question from Mugitimi.
Yes, I will try my best. Okay, so I think that's a great question. I think you can nudge people toward good behavior and bad behavior. So there's research that shows that, for example, the one-click checkout button from Amazon may nudges people to overspend. While there's also research that shows, for example, that the saving apps, if you put a picture of your child, it can nudge you toward saving more. So I think it's the responsibility of policy, or the opportunity of policymakers, to work together with those companies to establish or incorporate nudges that nudge people toward the right behavior, because it can go into both directions.
Awesome. Thank you so much, Judith. We have come to the end of the segment, and I think it was quite an interesting, thought-provoking one. We are now moving to our first policy panel discussion of today, which will reflect on interoperability and innovation, connecting existing infrastructures or starting from scratch. The session will be moderated by Anna Masocha from the South African Reserve Bank, National Payment System Department, where she's the divisional head for policy and regulation. Colleagues, please help me welcome Anna to the stage.
Okay, mañana then. Go back, I laptop back. Okay, I can move the mic. I know I'm short. So, delegates, when I was approached to moderate this panel, I asked two critical questions. First, how gender representative is the panel? And I was told, we've got a female moderator, so it's well represented. The second question that I asked was, what's the main objective of the panel? And then I was told to enhance innovation and interoperability with the ultimate objective of enhancing frictionless payments. Little did I know that frictionless meant removing females from the panel. But here I am. Good morning, everyone. My name is Anna Masocha, and welcome to panel 3 on interoperability and innovation, as Mavis has introduced, connecting existing infrastructures or starting from scratch. So, across Sub-Saharan Africa, and the governor touched on this very important point. Cross-border payments are a critical enabler of economic activity, from facilitating trade and investment to remittances. I think a lot was said about remittances yesterday. Yet these payments remain slow, remain inaccessible, and important for this session, they remain highly fragmented. So the G20 has set the roadmap for us. We've heard a lot about G20, with the work that they're doing with Financial Stability Board and the CPMI in making payments cheaper, faster, accessible, and more transparent. So within this global framework, and we just heard from Maha now, interesting stats from Sub-Saharan region, we face both unique opportunities and also complex challenges. So from an opportunity perspective, we have dynamic fintech ecosystems. We are told, we heard from Damola and everybody, that there's high penetration of mobile payments in Africa, and we are focused on regional integration, whether it's from SADC, COMESA, AACB. Yet, also the complex challenges that we deal with include constraints from legacy infrastructures, uncoordinated regulatory frameworks, and most importantly, limited interoperability, as Maha just pointed out. So the question today that we're exploring as a panel is, do we connect, do we leverage, do we harmonize existing payment infrastructures, or do we start from scratch? Meaning, is there a stronger case for newly built payment infrastructures to spark innovation and interoperability in the Sub-Saharan region? And both approaches have trade-offs. On the one hand, we are told the existing infrastructures, although they bring stability and continuity, they may perpetuate old inefficiencies. New infrastructures, yes, they spark innovation, but of course they come with complex governance structures and investment and the need for regulatory coordination. But to unpack all of that, I'm joined today by esteemed leaders that are advancing digital payments innovation and interoperability. And I'm going to call out the two speakers that are present in the room to join me here on the podium on the hot seats, and two other speakers are joining us from a virtual platform, and hopefully they are ready, camera ready for us. So as I call out the names, please, could you please join me on stage? So our first speaker is Kagiso Dichabe. Kagiso is an engineer turned business architect with over 25 years of experience advancing digital innovation and financial inclusion across Africa. He is the co-founder and chairman of FINASA. He champions fintech innovation and is a staunch advocate for supportive regulation. We note that as regulators. He leads initiatives like Moja Pay and serves on key advisory committees and contributes to continental and global fintech organizations. The next speaker that I will call up on stage is Shane Riddle. Shane is the founder of Elucidate, an AI-driven decisioning platform revolutionizing financial crime risk management, with sector roles as Standard Chartered, Citigroup, and Goldman Sachs, and experience in the UN as a diplomat. Shane combines expertise in finance, technology, and regulation to create a more safer and more connected global ecosystem. And then on the virtual platform, we're joined by Michael Richards. Michael is a principal architect at the Moja Loop Foundation. He leads the development of inclusive instant payment system globally with over 20 years in payments innovation. He was the chief architect for M-Pesa at IBM. He's dedicated to advancing Moja Loop's mission of interoperable low-cost digital financial ecosystem. And last but not least, we are joined by Arun J. Katakam, who is a writer, yes, a writer, speaker, serial entrepreneur, and currently the strategic and digital finance advisor at Interledger Foundation, dedicated to financial inclusion and poverty eradication by 2030. With a background in investment banking and international development, she has worked with GSMA, Gates Foundation, UN, while mentoring inclusive fintech startups. So welcome, panelists. Let's begin with a burning question for all our panelists. But before I ask that question, I need to, I was going to say, before I ask the question, I need to interoperate with the panel. So let me quickly do that. I will remain the hub and they will remain the spokes. Okay, so let's start with that way. Let's start with that burning question, panelists. So, Kahiso, I'm going to start with you. So, in your view, what is the most effective path to achieving interoperability and enhancing innovation in cross-border payments? Should we focus on connecting, harmonizing, and leveraging existing payment infrastructures? Or should we start from scratch? Is there a stronger case for building new fit-for-purpose payment infrastructures?
Thank you, Anna, and thank you to the SUB and the G20 for having us. It's good to be here. And I think for us it's quite simple. I think actually representing the fintechs in South Africa and also in the continent, our stance is we need to reuse where possible and rebuild where necessary. And which is extremely important, right? Because when you look at from harmonization point of view, it's important that a lot of work went into building the infrastructure that we have, whether in South Africa, the region, and the continent. And we're not going to go and reinvent the wheel. It does not make sense. So ours is let's reuse where possible and rebuild where necessary. And also, just to add on to that, people talk about financial inclusion. Financial inclusion is not only for the end users, but also for those that enable them, which is important, right? And sometimes those that enable them, let's say, for example, Tebogo back home, who is building a cross-border capability platform, he might not necessarily have the skills to start building a KYC app, but he can reuse what is already existing. And that would be cheaper for him and also for him to get to market quicker. So again, financial inclusion for the enablers, which are the fintechs, and also making sure that we provide capabilities that are affordable, accessible, safe, and also fast to go to market and also to reach the end users. Thank you.
Thank you, Kahiso. Shane, do you agree? What's your view?
So, a career spent in financial services has dissuaded me from ever making the perfect be the enemy of the good. So I think here, the idea that we would embrace the prospect of some sort of a nirvana of payments infrastructure essentially means that we would simply defer its benefits until such time as we give up on trying to build that nirvana. All of that is to say we need to focus on how to optimize the existing framework and to harmonize infrastructures in a way that allows us to maximize benefit. As the governor said this morning, payments are the driver of trade, and trade is the driver of wealth creation. It's the path out of poverty. So if we really want to achieve change in the market, we need to look at the most pragmatic ways to create the greatest benefit in the shortest amount of time.
Thank you, Shane. Short and sweet. So, from the virtual platform, Michael, this is the way you spice up things for us. So, what is your view on this burning question? Michael, you are on mute. Could you?
Sorry.
Yes.
Yes. I'm going to leave the spicing to Arunjay, who is an expert in this field. And I'm going to say I'm disappointed on two counts. The first count, of course, is that I'm having to join virtually rather than attending in person, which I had really hoped to do. And the second was that I had rather expected that everyone was going to say innovation. But in fact, everybody said, no, let's just improve. My position is somewhere in the middle of that. I think that, broadly speaking, a lot of countries on the continent have already made useful and productive efforts in the creation of national payment systems. Where things are much more problematic is in the interactions between those systems, if that's the way architecturally we want to go, to support cross-border payments. Now, I noticed that one of the panelists on the previous discussion was talking about Project Nexus, which is the BIS interoperable payment system. And it offers one solution to the two of the three fundamental problems for interacting between jurisdictions. The first of those is the question of compliance. Now, where you have multiple regulators with perhaps different regulatory regimes and a requirement to ensure that the participants in a payment are verified as not being terrorists or criminals, that's going to be a problem. The second problem is settlement. Now, in Africa, we are fortunate to have a continental settlement bank, a multi-currency bank in the form of PAPS. But I think everybody has agreed that so far, PAPS has not been quite as successful as everybody had hoped in offering this. And part of that, I think, is to do with the fact that it's dollar-based. It's converting into and out of dollars. Whereas I think everybody that I speak to on the African continent would very much rather see a system which offered direct conversion between national currencies on the continent. And the third, and perhaps the most difficult question, is currency conversion. Now, the reason currency conversion is such a difficult problem is that most of the ways in which payments are currently settled, as I'm sure you know, are via RTGS systems. And those RTGS systems typically are single currency and available at, shall we say, restricted hours. And we live sadly on a continent where exchange rates are, shall we say, somewhat more volatile than they are in other parts of the world. And that exposes all of the participants in a payment system, particularly an interoperable payment system, to exchange rate risk. That they are quoting a payment at a particular exchange rate, and by the time it comes to be settled, which may be a day or 2 days or even 3 days later, the exchange rate has shifted, and somebody has to bear the cost of that shift. So those are areas where I think really we need innovative solutions. Those solutions, insofar as they exist at all, are not very well not very well extended across the continent. And I think there's considerable scope for innovation in those areas. So that's what I think.
Yeah. Thank you there, Michael. You're raising very pertinent questions. Let's hear from you, RNJ.
Thanks, Anna.
RNJ?
And like Michael, I'm disappointed to not be there in person. But at least, technology allows one to participate virtually. So I think the challenge is manifold, and technology is not the problem or the solution. I think now, especially in 2025, we have seen a lot of adoption in different ways across the world in different technologies. So I think where we are today is really needing to look at it from a policy and a regulatory standpoint. So that for me is where the challenge lies. So I agree with Michael on settlement and foreign exchange conversion being a challenge, but even before we get to that challenge, that point, we need to look at why haven't payments worked domestically? So in Africa, there are 31 instant payment systems, including 3 regional ones, with yet more in development. So none of them have achieved escape velocity. That is, in comparison with the successful systems around the world, UPI, PIX, PayNow, the Chinese systems, etc. There's really no volumes to speak of. None of them are classified as inclusive, and most of them are not interlinked. So, if you can't make a payment to the person you want to make the payment to, because the IPS you are on and the IPS they are on are not connected to each other, that is a problem. So really, we have to look at, why all these systems in Africa fail to gain traction, and while we're busy building new ones without learning those lessons. Payment networks thrive on network effects. That is, the value grows exponentially as more banks, more non-banks, more players are on the network. In Africa, these effects are strangled by semi-closed networks.
Thank you, RNJ. I see Kagiso is burning to respond. So Kagiso, in your response, can you also share with us what you see, because you're advocating for reuse of existing payment systems. So what do you see then as the biggest opportunities and challenges, opportunities if any, and challenges for fintechs in building entirely new fit-for-purpose payment infrastructures that are interoperable? And what lessons can policymakers and regulators draw from this?
I didn't see that coming. I guess I asked for it. But I just want to touch on one thing that was mentioned regarding why certain systems don't work in Africa. It's not about why systems don't work in Africa. It's about we need to understand how Africa operates and work. And we build products and services that tie in with the way of life, right? And I just want to take a step back a little bit to saying that most of the time, unfortunately, we are very quick to building or thinking what the need is, but without understanding what is the real need. And walking and sitting with for example, how does someone send money home? We have a lot of migrant workers coming from other countries into South Africa. They come here, most of them are within the service working space. Either they're doing gardening, all these other servicing work. And as soon as they make money, they send it home. And the challenge that we have, and we're asking, why are they sending money using a bus still, the bus driver, and not using the technologies that are available? The reason is because we don't really understand how they operate. and how they work on a daily basis. I think yesterday it was in the research to say that when they send money home, it's not just money, but also send a bag of potatoes. And we need to start understanding the need. What I'm saying is that we need to start understanding the need. Technology is not the answer, it's just an enabler. And until we pull ourselves towards ourselves and understand that very important core principle, I think we're gonna continue chasing behind our tails. And going back to your question, obviously, coming from the fintech side of life, we are innovators. And most of the time we bring the latest and greatest technologies out there. But also we are realistic as well. And that's what I strongly believe, that there's a reason why fintechs collaborate instead of working independently. And people would also say that fintechs don't want to work with banks, but actually we want to collaborate. And for us, it's about, instead of reinventing the wheel, if a capability is there and it makes sense, we plug it in and easily can plug it in and make sure that we are building a connected and harmonized infrastructure. And again, talking about harmonization, I think that 80% of what is needed is already in existence. And then the other 20% that talks to the new and latest infrastructure and technologies, that's where the gap is, where we can start building new and introducing certain capabilities, especially within our corridors, right? We're talking about agentic architecture. Everyone talks AI, but how do we really use AI for example, doing KYC, real KYC, which is slick, cheaper, faster, and breaking that friction, making it a frictionless capability. And using the architecture, which is mainly agentic, we can also make sure that we tackle the likes of AML, which is, especially from cross-border payments point of view, that's where the challenges we see in that. Well, we're spending too much time on AML because of, it's cross-border. But do we need to do hardcore, for example, KYC or especially KYC for low-value transactions? If I'm sending, let's say, $50, right, back home, do you need my blood sample for that? And that's actually, that friction, basically the minute you have to take my blood, it means that, well, it's not going to be fast anymore because we need to wait for the blood test results and all that, right? But let's bring it back home into financial sector and what we are talking about here. There are certain core capabilities that we need to revisit as the regulator to say, do we really need certain requirements? I understand that. Yeah, anyway, thank you. I'm just going to leave it there. Thank you.
No. We get it, Kagiso. You are saying regulators stop introducing frictions in the system. We understand that. And you said that technology is not the answer, but it's an enabler. So I think it's a key takeaway from me. So Shane, you're also advocating for optimization of existing infrastructures. So, and also embedding compliance and risk management in payment infrastructures. How can this compliance by design approach enable faster and more trusted interoperable payment infrastructures?
I want to pick up on one of the points that was raised just at the end here. I tend to view discussions around regulators should do less. I think that's obviously we all feel that way, and I've sat through many regulatory examinations where I have had a deep sense of conviction that I wish that they would do less. But regulation and policymaking are sovereign rights. And I'm not about to advocate for building any infrastructure that is reliant or dependent upon the actions of any single regulator. If we say that we want utter harmonization and we want regulators to lower their standards, those two things just simply cannot be reconciled. There's too many stakeholders. You add to that the complexity of friction in payments is in part down to regulatory frameworks. I will concede that. But in compliance around payments, we have perhaps one of the most standardized regulatory frameworks that exists globally because it's very FATF driven. Not 100%, right? There are idiosyncratic requirements in different jurisdictions, of course. But I think a lot of the friction that we see in risk infrastructure is driven not only by regulators, but it's also driven by financial institutions who themselves have their own requirements that are unique and unusual. We see this, at Elucidate we tend to deal more with kind of the correspondent banking ecosystem as compared to the fintech ecosystem. But even in the correspondent banking ecosystem, we see that this bank is very happy to handle transactions originating from central banks, whereas that bank is not. This one will take downstream payments where money service business originated, this one will not. So harmonization is bigger than just regulators should do less. And the other point I think worth highlighting here is, thinking back to what Gloria said yesterday on the last panel of the day, the biggest driver around pre-validation that JP Morgan is seeing is a desire to reduce fraud exposure. So we talk a lot about speed and cost here, but the other factor which compliance is in fact a proxy for is integrity of the payments and safety of the ecosystem. So if we say, well, let's reduce all of our thresholds, as the Americans have recently done around CTR reporting, the trade-off is that we make it easier for illicit actors. To me, this is the wrong question. In 2025, we should not be asking questions around regulatory simplification that can easily be solved by technology. It made sense to ask that question in 2002 when we filed forms. By and large, I'm sure there are exceptions, some of which are probably represented in the room, we don't file so many forms anymore. So it feels to me that's kind of the wrong question. When we think about what is the infrastructure that's required in order to support interoperability and innovation within financial services, to me, what we advocate for is sort of derived from some of the learnings of Mandela and Aurora, that what you need is an independent and neutral compliance layer that exists to drive harmonization. So you're not saying that banks or regulators don't have their own responsibilities around compliance. They clearly do. You want to strengthen and enable those. But what technology allows us to do today is to reduce the burden on parties to actually have due diligence that penetrates into the counterparty. The due diligence burden on your counterparty, on the remitter, on whoever, this is what essentially undermines the commercial legitimacy or the capability to undertake certain transactions. By creating an independent risk layer that exists alongside the infrastructure. Our view is that we can enable institutions to derive the data that they need from transactions or from counterparties, simplify due diligence on those parties, and then you can achieve that trifecta of better, faster, and cheaper that we've been talking about for the last day and a half.
Okay, thank you, Shane. It's now seems like it's a regulator, less interventionist approach panel.
Sorry, can I just add one last point on this, though? What I would ask for from regulators, if there was a policy ask, it would be that regulators are more conscious of the operational impacts of their requirements. This, I think, is where the friction becomes very difficult to reconcile. So, if we think that financial services, whether they're fintechs or banks, they are no different than a production line at a factory. And you have to build for the output. And so as a regulator, if you come in and you have some abstract requirement that is very, very complicated to implement and requires a manual process, which is very often the case, and comes from simply a lack of understanding or collaboration with the market, the impact of that will be financial exclusion. Certain services will not be offered to the market because they are not economically viable. That could be addressed very simply through better collaboration with the private sector when you're drafting those requirements, not reducing the requirements themselves.
Well, I would say well captured, Shane. I'll come back to that thought later on. So for now, I'd like to move over to Michael. So, Michael, based on your experience with transformative payment innovations, what would you say are the most significant architectural lessons Sub-Saharan Africa can draw when designing interoperable cross-border payment today, and particularly in interlinking faster payment systems?
Thank you. Would you mind if I just picked up the regulatory question? I promised to talk about interoperation in a minute.
So,
would that be okay?
Yes, happy to. So what are the significant architectural lessons that the Sub-Saharan Africa region can draw when designing interoperable payment system?
Yeah, so we take a very simple view of regulation, and it is that every financial institution is adequately regulated by its regulator. It must be, otherwise it couldn't do on-us payments. So the question for us is not how should information get passed and who should do the regulation. The answer is simple. A financial institution should meet its own regulatory standards. The question for us is, do the regulators trust each other such that if another regulator's system says their customer is okay, that's an all right, that's a statement that says the customer is okay for all regulators in, let's say, a regional or a continental system. Now, I actually asked that question to a room full of regulators once, and they didn't even blink. They said, of course we trust each other. So if that's the case, all you need is to make sure before you execute a payment that each of the parties has warranted that its customer is a legitimate person who can make or receive that payment. And in my mind, there's a lot of stuff talked about in terms of harmonization of regulations, and I agree completely that we don't want a situation where we dilute regulation, and the better de minimis regulation is, in my mind, an egregious example of that. We dilute the effect of regulation in order to make life easier. We don't want to do that. But what we do want to do is to make a validation in the place that it's most sensible to make it. That is, in the regulatory environment of the customer. And I think if we can succeed in doing that, then we will have made everybody's lives a lot easier. Now I'm going to go on to the question of architecture, if I may. So that's that rant over, and I'll start another rant now. So one of the principles that's come out, I think, of the architectural principles that's come out of the work that we've been doing with payment systems in Africa is we want to foster an architecture in which individual jurisdictions can have their own possibly hierarchical payment systems. And by hierarchical, I mean that sort of hub and spoke system that you see, for instance, in Project Nexus. Individual jurisdictions can have systems like that, and there are very good reasons why they would want to have systems like that, particularly that systems like that enable financial institutions of very different kinds to interact with each other on a level playing field. So that sort of thing is important. At the international level, our view is that it's better to have some kind of peer-to-peer organisation. That it's unlikely that regulators will find good ways of constructing overarching authorities to manage the interaction between payment systems, and that the innovation needs to happen at the point where we say, how is it that jurisdictional systems can interact with each other such that a customer can make a payment to someone in another jurisdiction without needing to know that that customer is in another jurisdiction. They shouldn't have to do more than they do now. They should just be able seamlessly to find a customer anywhere in the interoperable payment systems and find ways of making that customer, enabling that customer to get a payment. There are obstacles to that, and those typically are the obstacles that I talked about in my first thing. The first, obviously, is questions of how settlement happens. And we've taken in our architectural decisions a rather similar line again to Project Nexus, which is to say that the currency converter, whoever that is, takes the responsibility for having a leg in both jurisdictional settlement systems. So that effectively, if you imagine, for instance, a currency converter who's offering conversion between Malawian kwacha and Zambian kwacha. They should be able to settle in the jurisdictional systems of Malawi and of Zambia, or at least they should have some way of doing that. It goes back to possibly correspondent banking or whatever it might be. But rather than say we need to wait until we have a regional settlement system or a continental settlement system that everybody can settle their payments in. We say we need a converter.
Yes, Michael, I can see you are passionate about this. I just wanted to maybe move over to RNJ, just to hear his views only on this issue, and especially RNJ, you advocate for inclusive digital public infrastructure, and even a zero-fee payment model. From your perspective, how can digital public infrastructure and interoperability frameworks be designed, to ensure that the end consumer truly benefits? I mean, we've heard from Michael confirmation of payee, seamless payment. So what is your view, RNJ?
Thanks, Anna. So inclusion is commercial. It's not charity. And I want to repeat that. Inclusion is commercial. On the continent, Safaricom and other mobile operators showed us how profitable inclusion is. M-Pesa in Kenya makes over $1 billion a year in revenue alone. But if there's still any doubt, India and Brazil settle the debate. Now imagine if you could only visit websites hosted on your internet service provider. If you wanted to visit a website hosted by another provider, you needed to make a request and wait for 2 days. So this is really the reality of cross-border payments. But the issue for me, like I mentioned before, is that there's no volumes to speak of on the domestic networks. And that is where the challenge lies. Because if you cannot get the domestic networks to be successful, then even interlinking them and solving the compliance and settlement and all of that is still not going to really move the needle very significantly. So coming to what we need to do, it's like we need innovation. And innovation can be inclusive without starting from scratch. Africa already has 31 instant payment systems. In those 20 countries, the innovation we need is the business model. What we need to do is look at the successful payments from around the world. And all of the ones that have achieved scale, well, guess what? Those are free. So India's UPI, Brazil's PIX, the Chinese systems, PayNow in Singapore, wherever you look, it's free. Now, let's take, for example, PayShap. It is new and improved and doing a lot of things better than the previous instant payment system, but the fee is still 7 Rand per transaction on average. So really, that is the problem. It's friction. The friction is pricing friction domestically, because you don't have a compliance issue domestically, you don't have a settlement issue domestically. So inclusion here is very much pricing. So the question is then, how does the industry pay for it? And the answer is simple: asymmetric business models. And the irony is that the banks invented asymmetric business models well before big tech scaled it even further. So looking at these domestic systems, I think, that is the key. SAB has been very progressive, taking a stake in BankServe and, looking at new technologies and how, they could change the way things are done, with verifiable credentials and other projects that I hear are in the works. But there are two major problems in PayShap. One is the fee of that banks are charging, and two is the discoverability of the app. It is often cited that it's hard to find within a bank's app how to, where's the PayShap functionality. The UK had this problem as well. They created a product called PM, similar to PayShap, except the banks buried it well deep inside the app. And the PIX, for example, the Central Bank of Brazil, they mandate that the PIX button appear in the top half of every bank's home screen. And that's what drove, in part, the adoption, because people knew where to find it. They could access it. And once you hit the PIX button in the home screen, the rest of the experience was the same. So, inclusion this is not a technology issue. It really is about, finding the right business model and making it accessible to people.
Yeah. Okay. Thanks for that, RJ. And I saw the PayShap operator is also in the room. So please take note of that. So panelists, we are almost out of time. We have got 5 minutes left. Thank you very much for the rich conversation. I just want to, before you go back to your seats, to, I think, share with us what is that one key action that could mostly accelerate interoperability and innovation in Sub-Saharan Africa in the near future, in your view? Kahiso, let me start with you. And if we can just take like 30 seconds each. With that?
Only 30 seconds. But I'll try. I think for us it's about harmonization in South Africa, in the region, and in the continent. And we're talking about, I think there's a lot of standardized regulatory requirements that we can achieve in these three areas. thanks to a great work that is being done by the Sub through PEM, which touch on it mainly, talking about PaySharp, talking about QR code standardization, and also digital financial identity. That is part of, I think, we are step in the right direction. And within FINASA, one of the things that we are doing strongly is advocating for working together within the countries. And one of them is licensed passporting, meaning that you are able to use a license that you have in South Africa in Lesotho. Again, in Zimbabwe. What that does, obviously, standardization of requirements from the regulators and also making sure that that interoperability happens freely and seamlessly. Thank you.
Okay, Shane?
Yeah, so again, I come at this from a risk and compliance angle, so I speak to that very specifically. You know, to me, the most concrete step we can take to reduce friction and drive interoperability is to create a mechanism for shared risk and compliance intermediation, that shared risk layer to sit between entities and between markets. That requires absolute clarity of requirements. I say this as a non-engineer, it needs to be engineering driven, right? The requirements need to be clearly articulated, the technology needs to be acknowledged and built for, and really critically, it needs to be neutrally housed. So, you know, in my paper, I advocate for the multilateral development banks as a house for, or as a home for that risk intermediation layer. That's not to say that's where it needs to go.
Yeah. Thank you, Shane and Kagiso. Moving over to the virtual platform. Michael, you have 30 minutes.
30 minutes? Great.
Apologies. 30 seconds. I know I'm generous. 30 seconds, Michael.
That's not quite so good. So I'm going to say something that Arunjay taught me, and that is, we all think that there's going to be a different world, a world in which there is real financial inclusion, and that's driving real better outcomes for poor people across this continent. What we don't think enough about is what that world is going to look like. Who are the winners going to be? Who are the losers going to be? What are the new things that can happen in that world that can't happen now? Because the more we have an objective that everybody shares and everybody thinks is worth striving towards, the more likely we are to come up with solutions that really help us towards that objective.
Yeah. Thank you very much, Michael. Arunjay, your last
so I thought we had another 10 minutes. This panel ended, you know, so a little sooner than I was expecting.
No, 30
and we
seconds,
didn't even get to talk about
Arunjay.
the elephants in the room.
Yes.
So, you know, I have to say before I conclude that, you know, stable coins are no longer experimental in Africa. They represent an estimated 6.7% of GDP across the continent. You know, blockchains are also digital public infrastructure, even though they don't fit the traditional G20 definition. They are faster, cheaper, and already achieving scale. But, you know, the issue that we have here is that, and the lesson that we need to learn is access and pricing determine adoption. And innovation isn't always about building new technology. Sometimes it's about having the courage to change how we charge for what we already built. Yeah. The technology exists. The demand is proven. The only question is whether we'll enable these systems to actually serve African needs, or continue creating isolated islands in an increasingly connected world. Thank you.
Thank you very much. And thank you so much to the panelists for that rich engagement. So as I reflect, I know that we are out of time, but as I reflect on the conversation that we've had now, a few themes stand out for me, and many of which, you know, echo the aspirations of the G20 roadmap for enhancing cross-border payments. First is that interoperability is simply not a technical problem. I think you also mentioned it's a systemic one. It requires alignment of governance frameworks, data standards, you mentioned data standards, risk frameworks, and regulatory cooperation. And that secondly, Africa has a dual advantage. We can build on existing infrastructures that already deliver scale and inclusion while also embracing new generation infrastructures. The opportunity, which is quite key and which is what I think is coming across from the panel, is that is to make both parts complementary rather than competitive. Lastly, is that innovation and regulation must evolve together. We got the message loud and clear today, and that we as regulators should play a critical role in ensuring that the infrastructures are not only interoperable, but they're also safe, resilient, and inclusive. And I would like to leave you with a pertinent quote from Christine Lagarde, who said, "Innovation and payments must go hand in hand with interoperability. Fragmentation is the enemy of progress in a global financial system." On that note, I would like to thank the distinguished panelists, Arunjay, Gahusho, Michael, and Shane, for your thought-provoking insights and commitment. And unfortunately, and apologies to our audience that we never got to ask you questions, but our panelists will be available to take any questions you may have at break. Thank you so much. Thank you, Mavis.
Very energetic conversations for a panel that started with a diversity issue, but I think that just went past our head because, my goodness, the views were flying left, right, and center. Thank you so much, Policy Panel 3. You've actually also done us justice from a timing perspective, so we'll now break for a comfort break, and we'll be back here at 11:05.
Okay, I just wanted to make sure you're waiting for others to join. Good afternoon.
Technical
Hi, Amar.
team, please just check who's on the line at the moment. We should only be able to hear the other colleagues who are virtual once the moderator has taken the platform. So we've been doing quite well from a timing perspective, and we are now going to be ushered into the first research session discussion of the day, which will reflect on measuring what matters, leveraging granular data to drive change in cross-border payments. This particular research session will be moderated by Radhika Singh, who is the head of public policy at Global Finance and Technology Network. Please help me welcome Radhika to the stage.
Good morning, everyone. This podium was obviously made for the governor and not for me, because I'm not even sure you can see me above this. However, welcome back. This is quite an important session, and I think a very good session to end 1.5 days of conversation around cross-border payments and remittances. Our discussion today that's going to unfold sits at the heart of financial innovation in Africa. The transformative role of granular data in understanding and addressing the challenges of cross-border payments. Now you can see we have the long names of the research that we're about to share with you in front. On the first one, understanding cost patterns in remittance corridors. This paper unfolds understanding cost patterns in remittance corridors, looking at why remitting money into Sub-Saharan Africa remains so expensive. And we've shared this nugget all of yesterday as well. It takes a macro diagnostic view, analyzing nearly a decade of World Bank data across 85 remittance corridors. It also shows how persistent costs reflect deep structural inefficiencies and regulatory barriers. Costs are still averaging close to 9%, and that's just confirmation of what we heard yesterday again, the highest in the world. It shows that high costs aren't random. As a matter of fact, they are structural, the product of fragmented systems, weak interoperability, and uneven regulatory access. Now, the three people that are going to share this paper are actually virtually online, and I'll do quick introductions of all three of them. Firstly, the author, Dr. Balakrishnan Madhavan, has a postdoctoral research fellow at IMM Center for Digital Public Goods. He has over 30 years of experience in payments and financial infrastructure, former CEO of NPCI, and a World Bank advisor. His research focuses on payments and digital public infrastructure. Together with him is Amar Saxena, a professor of practice at the Mumbai-based Public University and fellow IMM. He has over 30 years of experience in corporate leadership and academia, specializing in markets, data science, and research. And lastly, R. Srinivasan is a professor of strategy at the IMM Bangalore with only 25 years of expertise in strategy, platform, business models, and digital transformation, also a fellow of IMM, and he has been published extensively. He chairs the Center of Digital Public Goods at IMM Bangalore. And these gentlemen are online, as you can see. The second paper is Decoding Cross-Border Payment Flows in Sub-Saharan Africa, and as I call them up to the stage, I'm going to introduce you. Matthew and Pardon, if you can come up. Matthew is the Associate Director of Access Partnerships. He's a technology policy expert and economist with global experience in AI, fintech, and digital connectivity. Formerly at McKinsey, which we won't hold against you, and the University of Oxford, he specializes in AI governance, digital inclusion, and economic strategy. He holds a PhD in economic geography. Pardon Mujikachi, Vice President of Operations EMEA for dLocal, leads operational strategy across Europe, the Middle East, and Africa with a decade of experience in telecoms and digital payments. He is a graduate of the Nottingham Business School, leveraging technology for emerging markets. And last and certainly not least is my fellow female on the panel, Tabaseng Sabanda, who is the head of Regional Payments Africa Region in Standard Bank Group, driving cross-border and domestic payments strategies to enhance financial inclusion and innovation. Welcome. Sorry, and just quickly to say, Matthew and Pardon, your paper takes a more granular real-time approach, is a micro high-frequency predictive analysis using live transaction data from Kenya, Nigeria, and South Africa to show how digital economies are evolving in real time. It reveals how consumers actually pay, how they react to shocks, and what their choices are about trust, access, opportunity, and digital payments. So as you can tell, we have a very strong panel in front of us with deep knowledge and experience. These two papers are two halves of the same story, the systemic architecture of payments and the behavioral pulse of the people using them. So without much further ado, I'm going to hand over to Balakrishna and ask him to share his findings on his paper, and Balakrishna noting that you have 15 minutes.
Thank you. Good morning to all of you. Can you hear me? Can you all hear me? Srini, Amar, can you hear me? Okay.
Yes, we can.
Yes, we can.
Yeah, can you put the presentation, please? Good morning. My name is Balu, and we are doing this presentation. My name is Balu. We are doing the presentation together with Amar and Srinivasan sir. First of all, I would like to thank you for G20 and the BIS and Reserve Bank of South Africa for giving us this opportunity to present this paper. Next slide, please. So remittances are a lifeline for millions of people. In 2024, over $56 billion flowed into Sub-Saharan Africa. That's more than 10% of the GDP of several countries in the region. And in fact, it is more than 20% in Gambia, Lesotho, and a couple of other countries. And these funds directly support many initiatives in education, healthcare, and consumption. Next slide, please. So cost is actually a problem. Sub-Saharan Africa remains the most expensive region for remittances. Our study shows on an average cost between 7.97 to 8% for sending $200 compared to global average of 6.3%. In fact, the SDG goals of 3% is 3%. Therefore, actually the cost of sending money to Sub-Saharan Africa is more than double the cost of what is expected from the SDG goals. In fact, even the FSB report, which is released this month, also indicate the cost of Sub-Saharan Africa is very high. And as you could see, the lowest is in South Asia. We will dwell into that. Next slide, please. So our study objective is to look at why this cost structure. Our goal is to study the disparities in remittances costs across Sub-Saharan Africa, understand the structural drivers, and explore how digital public infrastructure can probably help reduce the costs. We used data from the World Bank remittances price worldwide data set, covering 367 corridors and 36 quarters from 2016 to 2025. So this has fairly rich amount of data, and we are able to come with many insights. I would now request Amar to go through the next set of slides. Amar, please.
Exactly. Thank you. Thank you very much, Balu, and definitely this is an extremely rich data set. Also, because it has a lot of information, besides just the cost on the corridor, it has information on the providers, it has information on how fast the remittances are being made and being made through the different parties. Next slide, please. First of all, the data cleaning, there are a lot of records. Now for Q1 2025, there were 6647 records, and we cleaned them up. Base is essentially duplicate records or the cost which are definitely wrong or missing information or less than zero. Like for example, if the cost for $200 transfer is missing or it's more than 500, or if the foreign exchange margin is less than zero, those records were removed. Overall, 7.5% of the records were removed. Still tolerable, it's not like very high. So the 6647 got reduced to 6160. For $200 transfer, we had, out of the 6160 records, the Sub-Saharan African, the money remittances coming into Sub-Saharan African region were 1334 corridor level observations. Next slide, please. The analysis that we are doing is two levels. First of all, we are analyzing the corridors. So it is any remittance which is coming into Sub-Saharan Africa. So it could be within the Saharan region, like for example, South Africa to Malawi, or it could be from outside of SSA, Sub-Saharan Africa into the Sub-Saharan African region. We are also doing an analysis of the country where all the corridors which are sending the money into a particular country, we are averaging the cost. The analysis broadly follows two parts. One is for a particular quarter. So when we are looking at Q1 2025, we average the cost for all the corridors for a group. And then at a country level, like I described, we are averaging the cost for all the things. We look at the trends. The RPW data is extremely rich. It has 36 quarters of data. So we are able to perform a trend analysis. And one of the important things in trend analysis is coefficient of variation. Is the cost remaining stable or not? So costs are high, that is okay. That is one part, that itself is bad. But if the costs are stable, then it's an even bigger issue. So those are some of the questions that we are looking at. Next slide, please. We looked at, there are two transfers which happen actually in the RPW data. One is $200 and another is $500. And we find that the $200 is significantly costlier than the $500 transfer, around 30% costlier. And so the primary analysis that we have done is around $200 transfer. As we have discussed earlier, global averages are 21% cheaper than SSA. South Asia is 37% cheaper. If we look at the proportion of corridors across the different cost ranges, there are only 2 SSA corridors which are less than 3%, the SDG coal, as compared to 25 corridors globally, which have a cost of less than 3%. 75% of the SSA corridors have a cost of more than 10% for $200 transfer. So this is definitely an important issue that has to be looked at. It has a very regressive impact on the population. Very wide distribution of cost, ranging from 2.2% to 25.7%. Now, this is actually, so this is, it is not just, there are some corridors which are showing very low cost, but there are a lot of the corridors which are showing very high cost. Worryingly, the costs are remaining stable. More than 50% of the corridors, 43 out of them, are actually having a CV of 20%, which means that not only the costs are high, but they are very sticky. In spite of the efforts that have, so many initiatives that have happened over the last 10 years, the costs are still stubbornly remaining high. The global data shows that costs below 1% are also feasible. Kuwait to Pakistan corridor has a cost of just 0.884%. Next slide, please. We looked at the various, now there can be various reasons for this high cost. One is the financial inclusion parameters. So we looked at the Findex 2025 data, and this was a country level analysis, not a corridor level analysis, where we looked at all the corridors coming into a country. We averaged the cost to find out the cost for remittance of $200 into a particular country. There are quite a few variables. We looked at the critical variables which will be important for sending money into a particular country, like account ownership, bank account, mobile money, savings, borrowing, domestic remittances, international remittances, and so on and so forth. We do not find any difference between the high cost and the low cost countries on these financial inclusion parameters. So the issues lie somewhere else, and it's not in the manner of financial inclusion. The MTAs provide higher, now this is one part. Now looking at the manner in which the transfer is happening, there are two main channels through which the money is sent. One is the MTO, and another are the banks. Banks are significantly costlier as compared to MTOs. And interestingly, MTOs send the money much faster as well. So it is typically 72% of the cases, the money is transferred within a day, as compared to banks, which take around 5 to 6 days. So we have MTOs not just sending the money faster, but also at a significantly cheaper rate as compared to the banks. The monetary unions, over the last 10, 15 years, there has been significant effort in actually establishing monetary unions. And here we find some interesting thing where the functioning monetary unions like ECOWAS or WIMO have a significantly lower cost as compared to some other, as compared to other regions, other countries. We'll be delving into that a little bit later. Okay, next slide, please. Palu, you want to take over from here, and I'll come in again.
Yeah, thank you. Yeah, so we looked at the payment infrastructure, like Amar indicated. We looked at the financial inclusion aspects first and figured out that that is not really the reason for this. The actual reason seemed to be on the payment infrastructure. We looked at RTGS, nearly it's universal, but not in many countries it's 24/7. As of now, only very few countries have 24/7. We figured out that only ACH is available only in 31% of Sub-Saharan Africa. And faster payment is available only 38% compared to 61% in a global economy. Even interoperable card switches are available only in 73% of the countries in Sub-Saharan Africa compared to 80% global. And this data is taken from the World Bank Payment System Survey. Next slide, please. When we looked at, Amar, you wanted to look at this?
Yeah. So like we said, so on the infrastructure part, is that really the issue where the costs are low? Now, as I said, ECOWAS and WIMO, these are the functional monetary unions. We find that the cost is significantly lower as compared to the Sub-Saharan African average, 13% and 21.3%. WIMO is definitely a much more closer knit and a stronger monetary union. As compared to that, SADC, which has been in formation for quite a few years, and it has yet to, become completely functional, the costs are significantly higher. So if there is one thing possibly this study points out is that stronger unions have a lower cost, the weak blocks have a higher cost. What can be done to make these stronger, these monetary unions like SADC into a stronger part? That could lead to reduction in the cost. Next slide, please.
Yeah, so we want to look at the implication of monetary union findings. What we figured out that the two monetary unions, which is working well within Sub-Saharan Africa, they do have an ACH system. One of the recommendations we wanted to provide is probably the monetary union should look at upgrading the ACH system to give an instant payment system called FES. When we looked at globally, more than 60% of the faster payment systems are actually achieved by upgrading the ACH. And upgrading an ACH provides not only economies of scale and scope, it probably would be less costly as well as a quick implementation is also possible. Therefore, one of our recommendations is monetary union can surely look at implementing the ACH, upgrading the ACH to provide an FPS solution. Next slide, please. Srini, you want to take this?
Yeah, our primary recommendation at this point in time is to be able to reduce the cost of remittances, and we are looking at how digital public infrastructure has been able to provide this kind of support. And in the geographies that we come from in India, we have had a significant success with real-time payments, and a lot of it is built around successful implementations of DPIs. When we look at DPI implementations across Sub-Saharan Africa, we have there are various implementations, but none of these are so much of cross-border implementations. Plus, a lot of non-banks are not being part of these implementations. There are some regional systems. Next slide, please. There are some regional systems, but these regional systems are largely focused on banks, and these are focused on wholesale real-time settlements, not so much about retail settlements. One of the major things that we come from, in the geographies that we come from in India, we've had a significant implementation of retail real-time gross settlements, and that has actually significantly reduced costs both within domestic as well as cross-border transfers. And therefore, one of our primary recommendations is to be able to implement cross-border this one, and implementation of these cross-border DPIs has significantly reduced costs. If you look at the next slide please, there are possibilities that we can actually bring down cross-border costs much lesser than the prescribed 3% rates. There are situations where Kuwait and Pakistan or Bahrain to Pakistan has been much lower. And the major enablers are digital identities, instant payments, transparency in foreign exchange, and competition between banks, fintech companies, as well as governments collaborate together to be able to provide good solutions. Within the corporation called Citibank has been able to do wonderfully in terms of their own transfers. Next slide. Next slide, please.
Our time. Okay, yeah.
Yeah. Balu?
Yeah. So therefore, our recommendation is, build inclusive DPIs, digital IDs, RTPS, and on the APIs. Implement fast retail payment systems by upgrading monetary union systems so that those countries can immediately get the benefit. Other faster payment system can also be linked using BAS Nexus solution. I heard during the DC FinTech, and I think even today Maha was talking about the BAS Nexus being ready for interconnecting systems that can be looked at. We have to extend access beyond banks, wallets, and mobile and fintechs. That has to be done. And we have to also promote consumer awareness, FX transparency, and cost tools, batching of the solutions. For example, we figured out doing $500 is cheaper than doing $200. Customer need to be educated about that. And then we also need to make sure that we harmonize regulations and across corridors, especially AFCTA pilots and those kinds of stuff. Next slide, please. So there are other possible options. I'm not getting into more details. I think stable coins are, fairly largely used. Somebody in the previous session talked about 7% of the GDP in Africa being stable coins. We can look at tokenized deposits, and we can also look at leveraging the international card network like Visa Direct and MasterCard, which are actually remitting the solution, right? Those are the things we could look at. Next slide, please. So based on the experience in Brazil, PIX, and India, UPI, which Srini's talked about, I think DPI will allow the payments to become an invisible rail and probably reduce the transaction cost significantly. In fact, we recently looked at the transaction cost for UPI. It is actually less than 1 cent per transaction. Therefore, we are able to offer it for everybody else much cheaper. There are global examples. We are happy to share more details if there are any questions and answers on that. Next slide, please. So this is the conclusion. SSI is most expensive, cost remaining stable over 9 years. Structural issues are there, banks and cash-heavy economy that need to be addressed. DPI would help, non-bank access would help, integration of other solutions will definitely help. Monetary unions can convert ACH into FPS for a quick gain. Long-hanging fruit, and we should definitely look at that. And we would ideally like, our vision should be from highest cost to most innovative region, which provide lowest cost, for the consumers in the region. So that's what we are looking at. Next slide, please. That's it from our side. Thank you so much.
Thank you.
Thank you, Balakrishna and team. While their information is fresh in your mind, does anybody have any questions for them from the floor?
I always wanted to do this once. This is not a question, but rather a comment from the floor. Just based on what we heard from Damola yesterday, who presented quite a vastly different spread of costs in the SADC corridor, I was wondering to what extent the remittance prices worldwide data is representative for our region. So I just wanted to have that general comment or question, because yeah, we're seeing different data being presented here for SADC from two different data sets, and we need to make sure that we know which one is right or whether it's in the middle. So are we measuring the same things? And yeah, I think it's important for just the credibility to just keep looking at how the data is collected and what it represents. So yeah, I don't have the answer. I'm just saying this from yesterday, we saw different cost realities in SADC.
So let me take this. I think we looked at, the only great source of data available to us is, the World Bank Global Remittances Prices Worldwide. I think they track quarterly, for the last so many quarters, and we use that data. If you think there are challenges on that, I think we are more than happy to work with World Bank and add additional corridors and additional methods. Therefore, we would have far better, understanding of what's happening. But I think 1,600 plus, data points, of which we use 1,300 of them for a quarter, is fairly representative of what's happening in Sub-Saharan Africa. That's the way we look at it, and I think, but we are happy to dwell into this a little more in case if you think there are some challenges in terms of SADC data. We are happy to look at that.
Thanks, Balakrishna. To the gentleman on my left.
Thank you.
Yeah.
Please introduce yourself.
Yeah, Mukitimi Mudaudzi, South African Reserve Bank. I think the data span is 9 years. Perhaps an unfair question to you, but I wonder if it's adjusted for inflation, because I think from a cost perspective, that's probably something very important to ensure that you adjust or at least take into account inflation, which might be an explanation in terms of why there is no deviation. But yeah, happy to hear what your view is on that. Thank you.
Yeah, thank you so much. I think we looked at the cost as a percentage of the transaction amount. Therefore, we looked at the percentage. We didn't look at the actual amount, right? Yes, I agree. Sometimes the fixed cost will have some implications on the inflation, but we looked at the overall cost as a percentage of sending $200 or $500 as a percentage, and therefore I think inflation is kind of taken care in our analysis.
And also in that percentage, we are seeing the percentage also remaining fairly stable. So the cost structure itself in the RPW data is not showing that inflationary trend that with the time the cost would be increasing or so. Like I said, more than 50% of the corridors have actually, the coefficient of variation is less than 20%.
Thank you. Tabase?
Yeah, I just wanted to comment. I had the same recommendation in terms of the data sources and just getting a local context from what Damola shared yesterday for SADC. And we also know that Africa Nenda has also done extensive research and tracks the rate of interoperability on domestic rails, which I think just gives a rich flavor to what we get at the World Bank level. Thanks.
Thanks, everyone. I'm going to move in interest of time to the next session. Matthew and Pardon, I'm excited to hear about your presentation, knowing that it has a micro lens and looks at the end user. You can stand here, yeah.
Can I have a copy of my presentation? Good morning. I want a copy for my presentation. Okay, Thank you. Good morning. Our submission is different. I think it's different from what we have been hearing. I think yesterday most of the submissions, they were about remittances in Africa. We heard a lot about intra-Africa remittances and flows into Africa. But our analysis takes a different perspective. We are looking at flows from African consumers and businesses being connected to global merchants. So the way we are doing it is different. We are unpacking cross-border flows in Sub-Saharan Africa. And we're doing it in a very unique way. What we have done is to take high-frequency data from dLocal platform, which provides what I call timely insights, which we believe that these insights are very relevant to G20 and the policymakers. I think more importantly, when you look at financial inclusion, right? How do we make sure that all the Africans are included and they are part of the global digital economy? So that's how we have, that's how we are analyzing our paper. I've got my colleague here, Matthew, is going to make a deep dive into the critical insights that we have mined, and I've got my colleague Ed in the floor. I'm sure he will join us at some point during the question and answer session. If you look at the agenda, I think there are critical pieces that we want to cover. The first one, we are going to look at just setting the stage, looking at the policy and the data context, just looking at the payment landscape in Sub-Saharan Africa, and also looking at our proprietary data. Then the next important piece is the empirical findings. This has got interesting pieces in terms of the distinct payment archetypes that we have mined from the dLocal data, and then we're going to look at the trends in terms of digital consumption that we've seen in this space, and also the real-time impact of policy uncertainty. I think most importantly, we then conclude by looking at how relevant these insights are to the policymakers. So that's our approach. So we're going to quickly cover that. But before we get into the meat of the conversation, there is a main challenge or a main problem that we're trying to manage here in Africa. It is about the payment landscape, which is fragmented and it has got a complicated ecosystem. I know the digital economy is exploding. It's in a mode of rapid transformation, but there are a number of roadblocks that we are dealing with here. This is of the fragmentation of the payment system. If you look at our customers or our consumers or our population today, Africans, they want to be part of the digital global economy. But there are a number of challenges that we need to overcome. They are looking for a trusted, secure payment method, right? But it's very difficult for them to be able to consume that or to be able to connect with the global merchants because of how we are structured today. So we're going to get into a bit of detail in terms of how Africa is unique and the challenges that we are facing today. There are a lot of friction that we see as our people are trying to transact on different platforms or as they try to be part of the global digital economy. We have got global merchants that are trying to offer digital goods and services just for them to connect to this world and make sure that our Africans, businesses and individuals are empowered. I think it presents a lot of problems, so we're going to unpack that. Before we do that, I think it's important, maybe some of you guys are hearing dLocal for the first time. So we're a digital platform, we're an empowerment platform. So what we do is to connect Africans, it could be individual or businesses, to the global digital economy through the trusted, secure payment methods. That's the solution that we are solving today. You might call it a bridge that is connecting these two worlds, or we are offering payment plumbing solution for emerging markets. But the way we are doing it, we're using a single API and a single contract, just to simplify things for the African population so that they are part of this global digital economy. Like what I said, we're not going to focus on what's coming into the continent. We're looking at pay-ins, right? Pay-ins, processing or collection, right, that our African population is doing, or the payments that they are trying to do today as they connect to global merchants. That is the thrust of our conversation today. If you look at what is happening today, markets are different. They've got different needs, they've got different requirements. What works in Kenya today won't work in Nigeria. What's working in Nigeria today, it won't work in South Africa because of how we are structured today. But the data that we are going to share with you guys is going to give you interesting insights that will help the policymakers. I will allow my colleague to get into a bit of detail.
Okay. Yeah, thanks very much, Pardon. Thanks very much to SAB and BIS for the invitation. It's been great to work on this project with a great team at dLocal, and also this was a good excuse for me to come back to South Africa, which is home. Yeah, just to build on what Pardon said. We think digital economic transformation in Africa basically outpaces traditional economic data collection. Of course, traditional economic data, extremely important for macroeconomic insights, but it's often highly aggregated and published with a significant lag, which creates an information gap for policymakers. So in this paper, we're using pay-in data from dLocal, which is basically organic transaction data, and we think this provides a very powerful complement to traditional economic statistics because it provides a kind of near real-time view of market dynamics, and it reveals trends and behaviors which are unobservable in the traditional economic data. So dLocal's presence is growing very fast across Africa. They're currently operating in 14 sub-Saharan African markets. We decided for this analysis to focus on 3 of them, Kenya, Nigeria, and South Africa, because these account for over 97% of transaction value in the sample. These 3 countries offer a kind of a very diverse set of merchant portfolios, which enables rich sectoral analysis. Okay, so more information about the data. We are focusing on the time period between November 2023 and March 2025, an 18-month period. The data is structured as a cross-section, which is aggregated by country, merchant, payment method, currency, and time. And at that level, we have both transaction volumes and financial values in both US dollar and local currencies. We used a kind of machine learning assisted process to categorize merchants into different categories. At the end of that, we're left with 170,000 rows of aggregated data after cleaning and getting rid of outliers. An important caveat, of course, is that this data is illustrative rather than exhaustive, right? dLocal works with a specific set of merchants, and that number is growing all the time, but this doesn't represent, all the global digital products and services that, people in Africa wish to access. So, yeah. Okay, I'm just going to walk you through what I think are like 3 interesting findings. The paper goes into much more depth, but the first one is about these 3 distinct payment archetypes, which this is very much kind of validating what we already know from other data sources, and I think it's interesting that you see these kind of consistencies in this data. So, this focuses on key payment methods and their value share for digital wallets, cards, and bank transfers over the study period. And what you see is South Africa is in orange. It's obviously represents a very kind of mature bank-led system. So credit cards and debit cards dominate when people are doing transactions on dLocal. For Nigeria, debit cards are also very important, but bank transfers represent 10 to 20% of the value share. And most interestingly, right at the end of the period, you see this big uptick in the use of digital wallets, which mirrors trends that can also be seen in official data. Lastly, Kenya, of course, is this mobile money-first economy, and you see this very interesting dip in May 2024, which will return later in the presentation. And of course, at the same time, you see, because this is the value share, you will see an uptick in the use of other payment methods in Kenya. Okay, so I already discussed that. Okay, and then, so this data is like very interesting for you to see very detailed information on exactly what individuals and businesses are consuming. So yeah, dLocal is extremely useful for economic development in Africa. If you think about like SMEs accessing Google Suite and financial SaaS products, they would do that through dLocal. If you think about rural communities accessing the internet through Starlink, that's also enabled by dLocal. And online education is becoming a kind of more important thing that people consume as well. So here you have in the 3 columns, Kenya, Nigeria, South Africa. You can see that e-commerce and online marketplaces are particularly important in South Africa. So a lot that people tend to spend a lot of money on those. But corporate services and B2B SaaS is a growing area as well as transportation and mobility. So that would be like dLocal enabling Uber to operate in South Africa, which of course has lots of kind of spillovers to the local economy. Then you have Nigeria, where people spend a lot of money on entertainment and services. So I think Nigerians really like Netflix. But then they also are spending a lot of money on financial services and money transfer on e-commerce and online marketplaces, etc. And in Kenya, consumers tend to spend a lot of money on telecoms, internet, and VPN, so like the essential kind of infrastructure of the digital economy. Okay. So lastly, I just want to talk about this very interesting kind of case from Kenya, which really kind of showcases the usefulness of this near real-time data. So I have some graphs to show you, but basically, for context, there was this proposed increase in excise duties for digital wallets in May 2024. The government announced this as part of a kind of package of tax increases. And in the wake of that, we see evidence that the kind of digital wallet value share plummeted from 60 to 40%. And so what actually seems to be happening is that consumers, people using digital wallets kind of misunderstood that this was just an announcement, and it wasn't actually hadn't yet come into effect. We see evidence from that because a lot of professional services and accounting firms made official statements saying that to clarify this is just a proposed increase. This hasn't actually come into effect yet. And yeah, so you can see in this graph at the top panel in Kenya, you see this kind of big drop in the transaction value when it comes to digital wallets, which picks up almost immediately. And what's also interesting is, so it picks up almost immediately because there were these widespread nationwide protests, and the Kenyan government decided to back down in the wake of that. Also, related to the protests, there were reports that the Kenyan government blocked Telegram. It also kind of prevented media coverage of the protests. And so very interesting because we also have information on the consumption patterns. You can see here in the top panel that there's this big spike around the same time in spending on internet, telecoms, and VPNs. So, yeah. Okay, so yeah, and I think that this basically, this case study reveals the very high cost of policy uncertainty and how kind of responsive consumer behavior can be. Okay, just to wrap up finally, so yeah, I think this analysis provides this a kind of useful model for how proprietary data like that from dLocal can provide very timely insights unavailable in high latency official statistics. Basically, you can very quickly kind of understand trends and how they evolve in near real time. So you can, for example, see the rapid take-up of digital wallets in Nigeria. You also have this like very detailed information on spending composition over time. So you can see, you can look into that kind of merchant level data to really understand consumption patterns. And then related to the kind of final case study I showed, it's a kind of really useful for understanding the impacts of public policies, even if they're not, even if they're not implemented, and also kind of other, potential external shocks. You can kind of measure the immediate economic costs of these. And so, yeah, the last proposal is just, we think there's like real room for doing more kind of ethical public-private data partnerships where, for example, central banks would be able to access the data from dLocal to get a more kind of granular view of digital markets for the purpose of informing policy. So I think that's, thank you.
Thank you, Matthew. I hope the regulators were listening to the impact of policy uncertainty and its impact on the economy, since we have quite a few of them here. But that said, does anybody have any specific questions for Matthew and Pardon at this point? So I don't see any hands. I'm going to move over to Taba Singh, who is our discussant and who is going to bring about a conversation from the angle of the human element and bringing the two papers together. Thanks, Taba Singh.
Thank you. Yeah, so these two papers were very interesting. I enjoyed reading them both and for different reasons. But more importantly, I think they really anchor the discussion about what we measure and how we measure it determines how we can effectively close that gap, not just on cost and access, but adoption as well. So I commend both papers, the authors of both papers, for the leadership and just the stimulating discussion that we've had leading up to today's session. So when we look at this research session and the question that's being asked, it's how do we explore granular data to drive change in cross-border payments? And for me, as soon as you say drive change, I'm asking myself, okay, so which data is being used? So that data source question that we asked. And to what extent are you bringing in that local flavor and context and that granularity? For whom are you driving this change? I think we need to make it human-centric. Who is the person or people that we are actually trying to impact? And of course, for remittances, we speak about migrants and their families. And in the dLocal example, it's more about digital citizens, again, across the span of mobile money through to banks. And then what is the change? I think we need to actually center this conversation about real impact and change when we leave this conference. And then finally, who will put the change into effect? This is a collaborative effort. A lot of stakeholders need to play a role, but we need to play a role in very different ways. And I think we need to actually get into that level of detail so that we're clear on the next steps. So we operate at an intersectionality of payments, data, and regulation, as those of us in the broader cross-border payments ecosystem, which speaks directly to the imperative that G20 has put before in terms of faster, cheaper, more transparent, and more inclusive payments. And I think that for me is then where I say we need to add the human element to this. So when we're designing policies, programs, and products, we need to define what inclusivity means, for whom, and how we shape that in terms of the cross-border payment ecosystem. And you'll see as we go along, or you would have heard from the papers as well, that you can't take a one-size-fits-all approach, and you need to get into that level of detail, not even so much at a regional, but actually corridor to corridor, because they don't behave the same way. So if I get to the first paper, the remittances corridors, and we center it around the who, just as a reminder, we're talking about the migrant that's left home and is sending money home back to their family. We know this. But I think what's often missing from this conversation is that this is in response to a need, a commitment, a culture, and in a way a pride in caring and connecting from home. So if you haven't experienced that in terms of having to send money home to family, I suppose in a certain extent we also do it for domestic remittances. But when we talk about cross-border, the food that they need, the medicine, funeral contribution, anything that your family needs, and especially if they need in an emergency, you are going to find a way to get that home, either through formal or informal channels. So the question for us in this room is, how do we make sure that the formal option is a choice for more people every time? So we need to be able to replicate that sense of community and connection that they have with informal channels. So again, in the interest of time, the authors took us through the pain points that they focus on, which is around costs. And I think for me, going into that corridor level reveals the nuances that you don't see at an aggregated level. What's also interesting is how it's cheapest from Qatar and UAE to Sudan. So where we think about last mile distribution being the biggest cost factor, you can see that actually if you have interoperability, high remittance volumes, and a more mature competition on the send side, you can actually affect and lower those costs. So again, when we look at then the more expensive side, I think for those of us in the space, no surprise that South Africa is the most expensive. But what is it that we can learn from the cheaper corridors? And you find that it's actually a very nuanced answer, and the factors that can affect a South Africa outward corridor are maybe not the same that would affect, for example, a Senegal to Mali one, which is another expensive one. But I want to focus, in the interest of time, on just one key insight, which is the first mile and making that more human-centric. We spoke over the last 2 days about a risk-based approach. But I'd like to actually take it back to that human element of the onboarding process. To what extent do our onboarding processes make a migrant feel more belonging, a more sense of belonging, or is it more about alienation? So we really need to examine that. And I think we need to look at that risk-based approach across the lens to say, from a regulatory point of view, what is the alignment across all the regulators so that when we take that on, there is that harmonization? How do we get a tiered pricing and the documentation on board so that you can then, within that risk framework, have that those cross-border payments come through and more volumes come through? But more importantly, for those of us that are in the space of providing these cross-border services, we need to design our pricing differently to other products and understand that actually by getting the remittance piece right, you can increase your share of wallet and provide value-added services like funeral cover and investments. So thinking differently about the remittance in terms of our operations and pricing models. So moving on then to the next paper, which was the D-Local one. Again, very interesting, very fascinating. I think a novel data set, and it just illustrates the power of data, again, needing to dissect and understand the domestic nuances across, and you can't just keep it at a global level or aggregated level. But when we talk again about the human element, this for me was more about digital inclusivity. And it's very clear that people are really connected to a global economy. So whether it is about, I'm trying to buy something from Shein and have that seamless payment process, I'm trying to keep my Netflix going, I'm trying to get an Uber. The point is that it is very important to me in my day-to-day life, it's very important to my lifestyle. And again, the data showed the elasticity of behavior, that rather than exiting the digital economy, I will find ways to work around it. And I think that's very insightful, not just for policymakers, but from a business perspective as well. So fascinating as well in terms of the different payment options across the three countries that you demonstrated. I do think there was one thing that was, for me, missing in the paper, which I suppose is an opportunity for a follow-up. It was around the data privacy. So these insights, as I said, are valuable for policymakers and businesses, but that same granularity of data and access to data real time, I think raises critical questions around data privacy and security and the responsibilities that we have in terms of consent, in terms of how we're storing it, how it's against cyber attacks and doing that securely, how we are also sharing it, especially across border. I mean, there are some frameworks that are looking at that. I think the EU wrote a paper, the AU wrote a paper about that in terms of a digital governance framework, which is something that can be explored outside of this forum. So in other words, data for good must be data with trust. So I think that's something that we can explore thereafter. But really just to wrap up, again, some other things that I thought about from a policymaker perspective, the value of having access to real-time data is also, it's only as valuable as policymakers can be responsive and agile to those changes that they're seeing in response to the policies that they've put in place. I suppose to a certain, you gave the Kenya example, to a certain extent, you could argue a similar context within the CMA. The other question I had just for us to ponder outside of this forum is from a financial inclusion perspective, could this data be something that could be used for alternative data for credit scoring? And then lastly, from an intra-Africa trade, could this be a catalyst to unlock intra-Africa e-commerce flows? So if I'm sitting here in South Africa and I want to expand my business across, could I use this data to see the behavior of a digital citizen in Kenya, Nigeria, or your coverage to then inform my business strategy? So in conclusion, coming back to the exam question, which was how do we leverage granular data to affect change? I think from a data perspective, with the remittances one, again, there's rich local context data that I think would enhance and enrich what is being done on a global scale. And I think the D-Local one from a novel perspective is definitely a case study of how that can then be expanded for the benefit of policymakers and business. For whom are we driving this change? Let us not forget to keep the person that we are impacted at the center of what we're doing. A migrant, a digital citizen, and creating solutions that are fit for their purpose and their needs, not necessarily centering ourselves. in terms of what the change looks like. There's the onboarding. There are other parts of that value chain in terms of middle mile, last mile that we can also affect. But there's also the public-private partnership, again, as I've mentioned, from an e-commerce perspective. But more importantly, in terms of who will affect this change, I think, again, as we go back to our corridors of and corners of cross-border payments, let us just keep that human-centric element at the center of what we're doing. Thank you.
Thank you, Tabasing. That was very insightful. I'm just going to give the authors an opportunity to react. Balakrishna, if you are still online, I'm not sure, but Matthew, in the meantime, maybe you can go ahead.
Sure. Yeah, thank you. So, can you hear me okay? That's for me. Okay. Yeah, thanks so much for the very insightful comments. Just to respond super quickly to a couple of things. On the data privacy angle, obviously a really important consideration, especially if this data is shared with central banks and so on. In the case of this study, the data that kind of I received to work with was already aggregated. As I used to be an academic economist, so I would have loved kind of individual level information as well, but that was removed from the data. I think DLocal is very careful when it shares data to protect individual level information. Then very quickly on the digital inclusion topic, which is something very close to my heart as well. I think DLocal is very useful for this in a number of ways. It provides access to kind of online services and payment methods to large numbers of people in developing countries. So 900 payment methods across 40 emerging markets, and this basically allows consumers who lack credit cards or foreign bank accounts to buy from international platforms. So that's really important. And also it kind of helps to reduce friction and costs in cross-border flows. So when a payment happens through DLocal, there's local payment processing, which actually means that it's cheaper than through international acquiring. For example, when someone wants to use Netflix. Any additional?
Yeah, just want to make some few comments as well. I think if you look at the impact, I think it's huge across Africa. If you look at Ghana, for example, we've seen 900% year-on-year growth. If you look at South Africa, which is a mature market, we're looking at about 125. So we're saying who is the biggest beneficiary is the customer. I think the appetite is very high. And I think the issue of financial inclusion, I think is critical here. I think it takes a different angle because we are saying is the African consumer or the African person or an African business, they want to be part of the global digital business or digital world. That's a different form of inclusion that we are driving. And for us, I think what is critical is giving our population access, right? Affordability is also key. I think we also talked about security. They want to be secure when they play in this digital space. So we are investing heavily across the continent just to make sure that the continent is covered and is included.
Hi, Balu here. Can I add?
Go ahead, Balakrishna.
Yeah, thank you so much. I think I just wanted to say three things. One, the technology adoption model talks about any technology adoption would depend on perceived usefulness of the particular product and perceived ease of use. I think that is something which all the countries should take care. Second, I wanted to also highlight the digital public infrastructure kind of an approach which India has done on UPI would be extremely relevant and useful. Third, the cost is an important factor across all the corridors. India, Brazil, and have proved how one can implement a cost-effective solution. And I think in our paper, we also talked about the monetary unions, which can immediately convert the ACH into the faster payment system so that the benefits can be immediate, the people can benefit immediately. And then once the volume grows up, one can always look at independent FPA solutions. And the Nexus project of BAS is very promising, interlinking faster payments. I think it is ready to launch, and I think it will be good if the SSA countries take an interest on that and try to implement that wherever the faster payments are available today. I think those steps will ensure that the remittances prices would come down significantly in the immediate future. And then we can work out. If Citibank has done this, SDG goals way back in 25 years ago, they were doing this. I think today technology has the capability. What is required is action. That is what is missing. Any amount of talk will not get us there. I think time to move on with actions. The first action should be making the instant payment available across the monetary unions and all other countries, and then interlinking them would definitely help us. And that way we would definitely help the countries have a lower cost, and the country will definitely significantly benefit from this. Thank you.
Thank you, Balakrishna. So in the interest of time, we can't open the floor any further. And I just want to close the session with a few reflections. I resonate closely with what Tabaseng was saying, which is that both these papers remind us that behind every payment lies a person. A worker sending money home, a merchant receiving funds, a family trying to stay connected. And we can combine the precision of data with the purpose of inclusion. We can transform cross-border payments from a cost burden into a driver of economic and sustainable growth. What these research papers have shown us is that granular data is not just informational, it's transformational. It gives us visibility into how people actually use payments and not assume how they use them from our ivory towers. And that visibility is what allows policymakers, regulators, and market actors intervene in smarter, faster, and more inclusive ways. So real-time data creates new opportunities. It allows us to detect friction, measure behavior, and design policy with precision. If we want to advance financial inclusion, lower the cost of money across Africa, then the data must be part of the infrastructure. We can't just build rails, we need to build intelligent rails. Rails that are interoperable, transparent, and responsive to human behavior. So we are presented with this opportunity to move forward from systems that move money to systems that understand money flows, and in so doing, bringing the benefits of integration to the people that rely on these channels and whom we all serve. And with that said, I would like you to give a rousing applause to our very clever and smart panelists from India as well as here in South Africa.
Thank you.
Thank you, everyone.
Thank you all.
Thank you, Radhika, for moderating a session that had us reflecting on the purposeful use of data. We are almost at the end, but we will not do the day justice if we do not leave without hearing perspectives from market stakeholders. I think there's been a lot of conversation that we need to collaborate, co-create, and this particular session aims to bring views from the market players themselves. So the session will be moderated by Brendan Pierce, who is the CEO for Finmark Trust. Please help me welcome Brendan to the stage, and he'll introduce his panel.
Thank you very much, Mavis. This is the graveyard session, the last session for the 2 days. You can see there's a good gender balance in my panel. That was all my doing, of course.
Can I invite my panel to come up? We may be able to save some time like that. Alex, Brad, Nikki, Answa. So I must declare up front that, like in Tabi saying, I focus, or we focus at Finmark Trust on the end user, the person that needs to use these payment products. We've agreed. So I measure any new toy. I know the techies, Kahisho and them, they like playing with new toys. I measure the relevance of those toys by whether they have a positive impact on pricing, speed, safety, and of course transparency within the process. So that's how I measure whether your toys are useful or not. And so that's what I'm going to use, engaging with the panel. We've also agreed that the discussion will be focused more on remittances, although it says payments more broadly. It's really cross-border remittances that we are interested in. Now, I've worked in this space for more than a decade now. I feel like I've had a ringside seat in what's happened to this SADC remittance market. And by the market, I mean the largest corridor, intra-Africa corridor on the continent between South Africa and its neighbors. Right, that's really the corridor that we're talking about. So I've had a ringside seat. I've seen over the 10 years the good, the bad, and the ugly. And I must say, although some of the data that is presented looks, quite depressing, actually there's been a lot of change that has happened in this market over the last 10 years. So we've reduced remittance costs by more than 50% during that time. When we started this work, it was 20% and higher. It would have been cheaper not to send money, just, I don't know how you do that. So at the moment, and again, the question about the pricing is an important one. What's the real pricing? What are we talking about? I think my colleague Damola presented yesterday a kind of more nuanced and granular approach to issues of pricing. And it shows that pricing has come down quite substantially. It looks very different. We are still, I believe, about 4 or 5% away from the G20 target that we need to be getting to, but we've made huge progress. The other area we've made huge progress on is moving from a largely informal market to what we believe is largely formal now. And of course, I'll talk about that ringside seat that I've had, what I saw as the main interventions that have brought us here, with the view to saying what interventions do we need to drive this reduction even further. Of course, having said the prices have come down, there's a worrying trend within the CMA where prices have gone up. And I keep, this is a drum, Arif, that I'm going to beat. I won't beat you with it, but beat the drum until we find solutions to bring those costs back down again, because they have serious impacts on people's livelihoods. So a lot has happened. I think the game changers have been in 2015, I think it was around 2015, where the licensing categories were opened up to non-banks to come into the space. At that time, banks were the only game in town. And again, I'm not going to be bashing banks. I'm already being accused of doing that. But the introduction and the creation of more competition is what was one of the main game changers that created more competition, more players, more products in the market, and prices came down. The second one was the issues around AML, CFT regulation. We started this before 2015. I see many of the people, Maxine, all of the people that were there working on these issues. The AML, we were looking at exemptions to the AML requirements from FATF at the time, particularly for low-value transactions and for poorer transactions. That process ended up within the risk-based approach, which I understand you discussed yesterday already. But that was the other main game changer. That game changer meant formal products could be made available to undocumented migrants. Migrants who are not legally in the country but have some kind of ID, positive ID that they could use. The other game changer was COVID. I'm not advocating for another COVID, but what COVID did was get more people into the formal sector because the borders were closed. And you've seen from the data that Damola presented, many of the corridors, those remained within the formal after COVID, after the borders were opened, and haven't migrated back into the informal sector, although there are some corridors where that has changed, but we believe for different reasons. So the South Africa-Malawi one, for example. And of course, lots of innovation by the particularly non-banks that came into the space. There's a proliferation of them at the moment, some more successful than others, but that kind of innovation that the private sector has brought has made the change. So as I say, we're about 4 or 5%, I think, away from hitting the target that we need to. We have also said at Finmark is that our interest is to look at how do we benefit the poor. So that means how do you get affordable, cheaper transactions, for the poor. And our focus is not so much on average prices and all of that, because it hides how much the poor actually have benefited over these last 10 years. So for example, one of the key corridors, prices are around 3%, even in a cash, even in a cash market. So that compares globally, actually. And so that's really what our focus, of course, the poor need more and more options like that, but they are now on the table and the poor have these cheaper products to, to actually use. Just to say, I think one of the main things remaining, and this is what my panel will help us with, is what are the changes that need to be made? What are the regulatory changes? And of course, what are the innovations and technology that can help us to get to reduce by a further 4 to 5%, right? That's what my panel is going to answer today before we walk out of VA. We'll write it down and we'll implement it. But to a large extent, our analysis is the remaining cash in, and Damola would have presented primarily the corridor. This corridor is still a cash in corridor. People take their cash to their agent or whatever it is to send that money. And it's that cash handling on the first mile and on the last mile that are keeping some of those average prices quite high. So, my panel, I've got 2 simple questions for them. And the one is, what are the frictions that you experience in what you have? So we've got 2 banks. We've got a global payment provider, and we've got a fintech non-bank that is operating in the space. What are the frictions that you have? We hope we'll move beyond just a gripe session about the regulator must do this and this. The second question is about what are the solutions that you see that we need to be implementing, whether it's innovation, whether it's regulatory changes, and how can we work together to make that happen? And then I've got a few more curveball questions that I'll tease you with afterwards. So we'll start with a woman on the panel, right? Just to show that this is really a gender, integrated panel. Ansar, we'll start with you. So I didn't introduce all of you, but the names are there. Ansar is from First National Bank. Nikki is from Mukuru. Brad is from Standard Bank. Alex is from Visa. Their bios are there, or you can Google it, as Maxine says, if you have time. So we'll start with Ansar. Ansar, that's the question. I saw at the clock there, we're giving each one up to 4 minutes for their responses. So Ansar, over to you.
Thank you, Brendan. I agree, there is definitely more that the private sector can do to improve cross-border payments. But we cannot ignore that South Africa isn't grey-listed by accident. We have a duty to protect the financial system and the tax base, and that cannot become a permanent barrier of innovation. For us, the real excitement lies in solving the changes that has been widely discussed today, and it is very encouraging for me to see that there's been very consistent themes that has been highlighted during these 2 days. And I want to just bring up a visual, if you can. So if you look at the challenges we don't have, the challenge is not in principle, but it is how regulations translate in practice across the different regimes. And what you will see on the screen is a summary of the requirements that the different regulations and frameworks, international and local, requires us information just about the payer. So it's just one screen about the payer, but it will clearly show you that we see a real opportunity for better alignment between international and domestic regulatory frameworks and policies. Especially in the last column where we see the threshold and then what is required to be submitted, in this case, just by the payer. So just to give you a practical example, in South Africa, we have balance of payments reporting, and the rules, even for very small transactions, still require full information. So purpose, SARS tax number, and BOB code. And if any field is missing, we have to stop the payment and contact the client. So there is no threshold that allows us for straight-through processing in that case. So during COVID, and I'm glad Brendan has mentioned it, so during COVID, there was temporarily allowed to process low-value transactions to simplify the requirements. And if we can just, at a minimum of 10,000 Rand, it will contribute meaningfully to the economy, and we've seen that play out during COVID when we had simplified BOB requirements. So as banks, we must balance innovation with duty. And I need to clarify this point because I've heard it several times over the couple of conversations over the last months, is banks absolutely follow a risk-based approach. But the law is very clear. The Immigration Act is very clear. We cannot allow business without legal presence in our country. So there is no grey about it. And we cannot be in non-compliance of the law. And then a very interesting point that I also haven't heard in the conference is we need to keep in mind that South Africa carries a very unique responsibility on the continent. South Africa is the only member of the G20. The South African Reserve Bank is the only Sub-Saharan bank, central bank in the BIS. And then South Africa is the only African bank representative at FATF. So that gives us a very disproportionate voice and also a disproportionate responsibility to demonstrate what the unique realities is on our continent. Thank you.
Thank you. Thank you, Ansa. I see you've brought files. You've brought all the detail with you. That's great. We'll go with Brad next. Seeing that you're sitting next to me now. Thank you, Brad.
Hello, everyone. You took it. You read my notes. Where is Olivia? No. I probably want to say something a little bit more, it's not controversial, but it starts begging the question, we've got to look differently at remittances. We get the regulatory pieces, and particularly in Southern Africa, it's challenging. And there's a lot that we can do there. And I also think that just generally, this whole forum is looking at, we all want to swim in the same direction. What has concerned me is, and remittances is in itself a challenging space, is the fact that the fragmentation in things like the infrastructure continues to prevail. And actually closed loop seems to trump open loop. And closed loop seems to trump interoperability. And yet that's not what we want, and it's not what is stated in the G20 targets. And you say, well, why is that? And you start, and yes, one of them is the fact that it's regulation and data and the facilitation of the data in a more efficient way. And I think the other challenge is that often in an interoperable space, it's difficult to prove the business case. And when we start driving down cost, the incumbents who want to participate can't just look at the cost to serve on a remittance alone. They have to start thinking, and it was Antonio over there who mentioned value-added services. And I think it's important that even as we measure, we'll put our metrics down that we want to measure, like get ourselves down to 3%, and that is the cost of the remittance. That is almost misleading because you really do need to look at where the business case lies. And it lies in the ancillaries, it lies in the adjacencies, it lies in the ability to really take yourself closer to the customer, and the customer experience. I think, back to what my message is, let's stop innovating in the middle. Let's stop innovating on the rails. It's a utility. We have utilities. Let's optimize these utilities and start focusing on where the real business case is, which is delivering to the customer at the customer sort of coalface. Thanks.
Thanks, Brad, for that. I think your comment about the kind of business rationale to make any of this viable, is a very important question, and a question that I think requires more discussion with regulators in the room to understand that. Something that we've bumped into quite a lot through so thanks for that. Nikki, I'm coming to you next.
So thank you, and I'm going to take also a slightly controversial approach to responding to the question. And it's not to be or to insult anybody, but the customer doesn't care about the regulation, they don't care about the tech, they actually just want to know they're going to get their money quickly, safely, trust the people that are doing, and make sure it lands there. And therefore, sometimes when we look at what we're trying to do in terms of bringing individuals onto the system, we maybe need to think a little bit differently and not always fall back onto the regulation, but trying to do it in a different way. From an ADLA perspective, the approach has always been, it's a product risk-based approach, which we know is very different to a customer risk-based approach. It brings in different dynamics and it allows you to do things in a different way. If we want to bring the low end of the customers into the system, we need to do that initially and then to grow off that base. And I think that's often where we hit a challenge, because that does imply that our compliance is different to the larger banks. It's not lesser, but it's different and it has different drivers, which has helped to push through that business case. It has helped, and that's why the ADLAs have been so successful. They've been able to push through the business cases. For us, the costs sit in the cash, not actually in a lot of the regulation. Definitely, from an AML and risk perspective, we are quite heavily compliant. There's a big chunk that goes into that. But the cash is an issue. But the cash is driven by that customer that doesn't care. The customer wants cash at the beginning and he wants cash at the end. And we can build what we want on either side. It's not going to change it. We have e-money licenses and we have a bank. But it's a different value proposition to try and move customers up the value chain. So I think the big thing is the compliance is still heavier for just that one product-based environment, and it does add a large cost, and we need to start understanding how we can do it. The other thing is the 4 million, not included, 17 billion, or I think it's 17 billion informal. Imagine if we could bring that into the system, what it would do to some of those costs, because we start talking volume and value. And I think that a mindset around rather bringing people into the system upfront is better than excluding them upfront. Because once you've excluded the low end of the market, they're not coming back. They're not actually going to come back and say tomorrow, well, you know what, actually here is everything else. And there's also ways to bring other people, which I think is going to start helping the whole situation.
Thanks, Nikki. We'll come back to this question about cash, because I think it's a major issue topic that we need to be addressing even before we get to moving customers up the value chain. Alex.
Hello, everyone. First of all, just really want to quickly say thank you for inviting me and inviting Visa. I've had a really wonderful time here. It's a real privilege to be in South Africa with everyone, so thank you. When we think about challenges in cross-border payments, from Visa's perspective, there's 3 areas that really make it difficult. The first area is regulatory questions. So, differing standards, different licensing requirements. My broader team is responsible for growing Visa's network beyond card payments, so our regulated money movement network around the world. And yeah, differing licensing standards are challenging to navigate. I was really interested in the research by the colleagues from Bangalore. I'd not seen that before, but I thought their mention of the monetary systems, I think it's critical. You cannot ignore monetary systems. You just mentioned cash, the differing composition of central bank money versus commercial bank money within a society has a massive impact on how you can move money around. Different money has different payment capabilities, so you cannot divorce the payment from the monetary system. And then the final area is more settlement innovation. I describe it more broadly. And Tara from the BIS yesterday gave a nice illustration of that, the front end versus the back end. We've had incredible innovation on the front end, contactless wallets, mobile money. We can talk a bit more about that. But there is still a lot of reconciliation, batching processes on the back end, and there's various initiatives that are going together. I think there requires lots of focus there. And yeah, really interested in the informal point of view as well. Brenda, I think digitization has to be part of the answer. And I think as we've seen through various, the mobile money statistics, it's kind of undeniable. I think in terms of bringing more people into the system, and I think it would be great to see more research about how bringing the informal members of society that are using those channels through mobile money, how that can have a positive impact on the broader financial system, including the banking system. I think that would be great to see more research on that going forward as well. So thank you.
Thank you very much, Alex. I mean, there's a few issues that have come up through this conversation about what the blockages are. I mean, I think the one issue is, given the context that we're sitting with between 4 and 5 million, some say 15 million migrants, the migrant population, the vast majority, more than 90%, are undocumented migrants. And so, Nikki, if we want to bring them all in to the formal sector, what does that mean? Now, the situation we in is, on the one hand, you have financial sector regulators that have adopted the risk-based approach. In fact, the ADLAs are processing transactions for undocumented migrants on the basis of their IDs from the country they come from. But you have an Immigration Act that says you can't do this. You shouldn't be touching undocumented migrants. Now, it seems ADLAs are following the one, and it seems the banks are following the other. I'm not sure how do we resolve this issue? This is a policy regulatory question for the country. Maybe it's not for you, but I thought banks should be able to do it under a risk-based approach. Answer? I told you there will be a curveball at some point in our conversation.
Yeah, thanks, Brendan. So we are also required to hold deposits for banks, and with that whole process, we are required to do a whole lot more to be able to protect their customers. So, and we are differently regulated to an ATLA. An ATLA's got very differently licensing and regulatory requirements compared to a bank that we need to adhere to. So if you compare the AD, authorized dealing license, and ATLA requirements, it's very different. And I think this is what excites us, is to see that change so that we can have a level playing field to play. And maybe to just add is, if you do look at, let's take the Zimbabwe SA corridor. This is the corridor with the highest rate. 80% of it is formalized, but there's no banks playing in that market. It's ATLAs playing in the market. And so you need to ask yourself, why is it that no South African bank is playing in that market?
Brad, you want to weigh in on this issue?
Yeah, I think the
The difficulty we have as a banking industry is that we are so diverse that we have to comply with so many regulations. And I go back to the business case. In so far as remittances is concerned, yes, there's a business case and we need to be in there, but the risks are high in other parts of our business, and we don't want to run the risk of losing our licenses or our license. And so we would rather comply or over-comply than to actually to adopt a far more a risk-based approach. Yes, we should be taking those steps, but we don't want to do it at the expense of our business and our position as a foundation of the financial services provision in I guess not only South Africa but across the region. So it's such a difficult world where a fintech who has got a very singular approach, maybe you've got a platform, you're going to supply services, but it is quite dedicated to a particular element and segment. A bank cuts across from corporate right through to consumer. And when we start getting down to the areas of having to provide to a person who only deals in cash, comes undocumented, yes, a risk-based approach is, we're all looking at it, we're trying really hard to find those elements that we'll be comfortable with, and we know we want to play a stronger role in it, but it's not going to be at the risk of the rest of the business. And the rest of the business is significant. It's absolutely imperative to the functioning of these economies that these banks protect themselves.
No, thanks for that. It seems like there are issues beyond the Immigration Act that need to be taken into account when we talk to banks. That's great. I wish we had more time to drill down into some of these issues, but I've been told we've got a hard stop. So let's jump into the second question. Alex, let's start with you. What do we need to be doing, focusing on, and maybe talk a bit about maybe new technologies, stable coins, all of those that can help us in this process?
Yeah, so we heard from the SWIFT presentation yesterday and various the discussions that the last mile is still difficult in particularly remittance corridors. And so the Visa Direct network that was mentioned in the presentation, the vision is to be able to connect to accounts, to wallets, to cards, so to build a network of endpoints. So that's the broader Visa Direct ambition. But I do think we've talked about how technology is not the answer. It's mainly regulatory governance discussions. However, I think there are some very interesting technologies emerging. So particularly around tokenization. Visa's a member of Project Agora, which is run by the Bank for International Settlements, which is experimenting on upgrading commercial bank money and central bank money to be on the same unified platform. And I think that whilst the percentage of payments being made in decentralized finance is still small compared to commercial bank deposits, the technology is very compelling, it's fast, it's instant, it's 24/7. So I think there's a lot to learn from engaging in these innovation projects to understand more broadly. But again, it connects back to my early point that you cannot separate the monetary instrument from the payment capability because they're fundamentally linked. There needs to be constant discussion within societies about the monetary aggregates as well as the preferred payment methods if we to move this forward.
Thanks, Alex. Ansel, we can continue with you.
Yeah, I think it is, in terms of new technologies, I'm absolutely an advocate of using what we've got. But for me, Antonia also mentioned it, it's really about what is the incentives, because companies, humans react on what is our incentives, and really creating assigned accountability. And hopefully with this conference we've seen themes. It would be fantastic if we can get the core themes that's come out of this conference and identify what is the high impact, lowest hanging fruit that will actually really drive the change that is desperately needed on our continent.
Great, thanks, Antoine. Nikki, you, Mukuru at one point had reduced the cost of cross-border remittances by more than 50%. So you were cheap then, but now the game has changed. And I'm looking at Mukuru and saying, how do we get that price down to the level you want to see? Given that you're such a big player, you should lead the market. What do you need to do that? What help do you need to get us there?
I think it's a bit of an unfair question.
I warned you there'll be a few curveballs.
So, I mean, as we said, cash is costly. And we really talk about being a remittance-led neobank. But it's not as simple. I mean, we're very excited about what happened in SA. We're really excited to be able to offer a store of value, and hopefully that'll stop chipping away at. But it actually goes back to really the cash. So I think that's a big one. I think the other one is, and it really isn't a knocking around what we do. We do not want to introduce any sort of risk to the integrity and financial integrity of the system. I mean, that's really important. But bringing in informal remittances to get more volumes really is something that should be focused on. And there just needs to be some changes to make that a little bit easier, and how we could then manage the risk in a different way. I think that's a really big thing. I mean, those are most probably the two. You look at our infrastructure, I think it's over 320,000 access points on the continent. You know, that also costs money, but customers want you to be where they are.
Sorry, Nikki, can you move closer to... You've lost your shouting voice.
Oh, I've lost my... I'm not with Finmark anymore, so I don't shout. But it really is being pragmatic around that customer and how we bring more in and help reduce the prices, how we stop or reduce those blockages. I cannot emphasize how hard it is when, you know, it's very easy to lose a customer because you tell them to come back because they need, you know, you need more. You don't get them back. They really don't want to come back to you because already it's a very tough thing. They're vulnerable. And it's how we can ease some of those where people fall off, or some of the high costs, which is cash. No one wants the cash. Those are big things. I think also expanding the role of what remittances can do, where, for example, things like, you know, can we pay directly for goods in a country at low value? Can we use a remittance to pay for airtime? That's real value added. I mean, if you think about it, we've done some research, and if my mother wants electricity in Malawi, I send her a remittance. She goes, she cashes it out. She walks 3 kilometers and inserts it into the prepaid environment. If we can try and shorten some of that and reduce those costs also, which will also make it exciting. I mean, getting onto the B2P and the P2P environment is, I know it's a tough environment, but your informal workers at the low end of the market that need solutions are exactly the same as your consumers at the low end of the market. And if we could bring in that also and start getting those volumes through and moving people through, it starts to become really exciting for that. And then you take them up into the formal everything that they're not really for.
Great, thanks. I think you answered my question about how do we get Mukuru to reduce its costs. I think you said take cash out of the system, right? Okay.
That's not that's a customer's requirement.
No. Yeah, sure. Sorry, Ansa, I just want to get to Brad quickly, and then we'll have a few more.
I think Nikki's right. It's we underestimate the first and last mile elements, the cash. Sorry, here we go.
Closer to you.
We underestimate the first and last mile impact. We saw that stat yesterday. It isn't about the bank. It isn't about SWIFT. It is about the last mile and the first mile. I use the word bridge because I think that the market still wants choice, which is why we cannot decash. I think cash is going to be around for a lot longer than we think. We're going to have to be mindful of that and find innovative ways at the point when you're serving the customer. when you're onboarding the customer and when you're transacting with the customer who wants to give you the physical form factor. They not only want the physical form factor because maybe they just don't have the store of value, but there's a relationship with cash which is really hard to change with the person who deals with it daily. They don't have, so first of all, it's cultural. Secondly, it's because probably they're undocumented and it's a hell of a lot easier and more efficient that way. The fact that the chances are the platform doesn't give you everything that you need. So I'm going to have to come out in cash again, and then I might as well stay there. We were talking about it at the coffee break. So then I'm going to stay in cash. And it's a difficult one because that's where the cost comes. Hello?
You've
got someone extra.
Sorry, can you mute your mic, please?
Okay.
Sorry, right, continue.
Lost my train of thought now. That's age. Eh? No, I've lost it. It's fine. It'll come back to me.
It'll come back. Age does that sometimes. Sorry. I'm sorry, you wanted to come back in.
Brendan, to your question, how do we bring down costs? So means of payment. Electronic payment, 4%. Everything cash, more than 10%. So if you go back to what we're solving for here, and the BA's data, so aggregate data tell us that there's a problem. There's a problem in Sub-Saharan Africa with remittances, 9% average. But then experience on the field, which all of us has, tell us then how do we solve this problem. And I think this is very important in terms of the discussions that we're having here.
No, thanks. Also, let's not pretend there's nothing happening in the regulatory space to enable at least a store of value in the first mile to deal with the issue about cash. So Anna's work that she's doing, and I'm hoping we can move it faster because the rest of the world is moving away from us. We're almost done. I just had one more question about talking about market infrastructure. Sorry, I do have two minutes left, right? Okay. Talking about market infrastructure, at the retail end, the TSIP scheme has been in place. I just wanted to quickly get your comments on it. Maybe we'll take one bank and one non-bank on it, and then there's at least one question in the audience that needs to come in. Who wants to go first?
Me. We're on round 3 of CMA. Round 3. Again, I don't think it's about the tech. I don't think it's about the utility. TSIP is probably not going to bring down the cost. Probably not going to bring down the cost. Where the cost will come down will be when we create the levels of efficiencies around data interchange, sharing of data across regulatory environments. There's a concept of regulatory reciprocity, where you can trust one regulator to fulfill what you need to do on the receive side or the send side with another regulator. That's when you're going to see the benefits of TSIP. TSIP's here to stay. I'm comfortable with that, and we know that it's going to. I also just want to say this point that we have to find a way of making sure that TSIP is relevant not only for just CMA and SADC, but it's also relevant for the continent. If it is about interoperability, the hub and spoke model, I think, is a great way to be looking at this thing. It may be broader than that, but I do think TSIP is a great start, but I worry that it's not going to materially bring down pricing to the market.
Sure, that's my worry. Nikki?
Yeah, Brendan, I worked on TSIP and with you and Maxine before. It is a very bank hub and spoke approach to how it's an EFT. There's a whole lot of interesting things in there. The models that the Adlers have put in to support their low costs, it is very hard for us to create a business case at the moment. And that is the real challenge. It really is. Because historically, because the Adlers have been doing this for so long, they've developed the state-of-the-art technology already. And the middle mile is not where our costs are. It's not where our costs are. And I think that's where the balance. And I mean, I'm going back in now to really get into the depth and break it down into customer value proposition and sitting with the teams. But
thank you very much. Sorry, Arthur, we've run out of time. I know. Arthur is insisting.
We've heard of Adlers buying banks. What about the banks buying an Adler and then being able to operate in both markets?
I've seen a few banks partnering with Adlers recently, so it looks like that is happening. I think Capitec and Mama Money or something like that. But thank you very much, colleagues. I'm not going to summarize. I think the issues are quite clear that came out of it. Please thank my panel. I think they were a great panel, great insights. Thank you very much. Over to you, Mavis.
Thank you so much, Brandon and the colleagues. We are now at the end of the event, and as it will be fitting to receive the closing reflections and key takeaways from the head of the National Payment System Department at the South African Reserve Bank, Arif Ismail.
I'm competing with the clock because they've got to come in for the Monetary Policy Committee. So Mavis has kept me on the, tightened narrow. So I'm going to try and keep this brief. I have the pleasure, of course, of closing day 2 of this important G20 BIS and SARB-led conference. Up front, the sheer quality of the presentations, discussions, questions, and moderation has been exceptional. And on behalf of the G20, the BIS, and of course the SARB, thank you for this. I thought I'd just thank and close, but opted to share some summative thoughts. I hope it's helpful. I'll try to keep it to 4 or 5 minutes as best. I'll cover this by 5 overarching high-level themes emerging from this excellent dialogue. 1, why cross-border payments matter now. 2, the urgent case for Africa. 3, why strong coordination matters. 4, what must be done, especially for Africa? And then finally, in Balakrishnan's language, a call for action. So 1, on the cross-border payments and why it matters now. We heard cross-border payments are the bloodstream of the global economy. They enable trade, investment, remittances, and financial lifelines that sustain millions of households and small businesses. The IMF, Eugenio, reminded us that the global cross-border payments market, traditional and digital combined, now approaches $1 quadrillion in annual flows. That scale alone tells us that the system is not peripheral, it's systemic. And yet so many speakers reiterated. For too many users, the experience remains frustratingly poor, in Nikki's words. Too slow, too costly, too opaque, and too fragmented, as the governor said. We were reminded many times during this conference that in 2020, the G20 obviously launched the roadmap to enhance cross-border payments. The vision was clear: to make payments faster, cheaper, more transparent, and more inclusive. 19 building blocks that were agreed upon, and real progress has been made. But as the latest FSB consolidated progress report makes clear, Thomas, we are not there yet. Or we are not where we need to be. The pace of improvement is uneven, and for many developing regions, the pain points persist. So too, the urgent case for Africa. Nowhere is this more evident than in Africa. A continent of extraordinary promise, but also acute payment friction. As you've heard, Sub-Saharan Africa remains one of the most expensive regions in the world to send remittances. And of course, there are questions around reliability. We heard the numbers, 8% in fees. And sending money through banks, Brad, still costs much more than that, on average 12%. And Tabi Seng, Radhika, you said behind every payment lies a person. These are not abstract numbers. They are the difference between a family receiving school fees on time or not. They are the margin that decides whether a small business exports or stays local. They represent the cost of being connected or excluded from opportunity. Beyond cost, as Barbara said, Africa faces structural barriers. You've said it many times. Fragmented regulatory frameworks, Answa, limited interoperability, few cross-border linkages among fast payment systems, MAHA, and slow adoption of ISO 20022. The result? Dozens of promising national systems, but too few that talk to each other. 3, why coordination matters. We met at a moment of heightened urgency. Global economic headwinds, high debt, slower growth, growing fragmentation make efficient financial plumbing more important than ever. From the governor, the pain points in cross-border payments are no longer mere inconveniences. They are strategic impediments to growth, inclusion, and resilience. We heard from many speakers, again, Barbara, that the good news is that the building blocks for change are already in our hands. Fast payment systems, ISO 20022, interlinking infrastructures, and digital settlement solutions all exist. What is needed now is implementation at scale, policy alignment, we get it, and laser-focused coordination across borders and sectors. But let's be honest, time is running out. The G20's 2027 targets for speed, cost, access, transparency are now just a year away. And the latest assessments tell us we are off track. As Balakrishnan kept saying, action can no longer be deferred. 4th, what must be done, especially for Africa? Allow me to propose 3 areas. Target the most cost-intensive payment corridors. We must direct our collective energy towards corridors where costs and delays are greatest, particularly intra-African trade and remittance routes. Reducing the average sub-Saharan remittance cost from 8% or so to the global goal of 3% and eventually to 1% must become a shared mission. Next, interlink infrastructure and promote interoperability. In Brad's words, these are utilities. Africa has now got, as we heard, close to 30 live faster payment systems, but interlinkages remain limited. Connecting these through harmonized APIs, etc., is essential. Every domestic success story should become a regional building block. Okay? Strengthen regional leadership and ownership. I won't say too much more about that. Let me finish by saying, here's a call to action. As we leave today, let us commit, and I think we have, to turning the roadmap's words into deliverables. The frameworks are ready, now comes execution, measurement, and accountability. Let us keep Africa at the center of this transformation, not as an afterthought, but as a frontier of innovation and impact. Let's coordinate across borders and sectors because silos breed friction and collaboration breeds efficiency. And as we heard, let us measure and report progress openly, Damola and Antonia, because what gets measured reliably gets done. Finally, we stand at a pivotal moment. The convergence of technology, policy ambition, and shared global resolve gives us a once-in-a-generation chance to fix the world's financial plumbing. If we get this right, we unlock not just cost savings, but inclusive growth, deeper integration, and real economic resilience. If we fail, we risk perpetuating inefficiency and exclusion, a luxury no country and no region can afford. Thomas, the world is watching, the case is urgent, and the responsibility is shared. With that, I thank you, and we look forward to the concrete next steps. Ciao.
Thank you, Arif, for those closing remarks. We have certainly come to the end of the program for the conference. Just once again, thank you so much for your attendance, your participation in this key cross-border payments flagship event. That was one of the last activities that we had indicated under the South African G20 presidency leading up to the summit taking place next month. I know that I have had a call for the papers and the presentations. They will be available on the conference webpage that is on the ResBank dossier website by the end of the day, and you'll be able to access them there. The videos equally for yesterday and today are available already on the webpage. With that being said, thank you so much to the South African Reserve Bank colleagues and the CPMI colleagues who worked tirelessly over the past 11 months on the actual deliverables that gave rise to this event. And to the organizing team, as well as the technical team, thank you for making this a seamless event. Ra leboga. Have a safe journey home, and lunch will be served where we had lunch yesterday. Thank you.